I declare open this hearing of the Parliamentary Joint Committee on Corporations and Financial Services into small business insurance, which is why you are here. The committee will be conducting today hearings in person and via teleconference. These are public proceedings and being audio live streamed via the Parliament website, and a Hansard transcript is being made. I remind all witnesses that in giving evidence to the committee, they're protected by parliamentary privilege. It's unlawful for anyone to threaten or disadvantage a witness on account of evidence being given to this committee. Any such action may be treated by those in the Senate as a contempt. It is also a contempt to give false or misleading evidence. Witnesses have also a right to request to be heard in camera. If a witness objects to answering a question, they should state the grounds upon which the objection is made, and the committee will determine whether it will insist on an answer, having regard to the ground which the request or the claim is made. If the committee determines to insist on an answer, the witness may request to answer be given in camera. I remind any committee member and witness who are appearing via teleconference to mute their microphones when they're not speaking. I understand the information on parliamentary privilege and that the protection of witness evidence, of giving evidence to the Senate committee, has been provided to each of you. Yep. For the Hansard record, would you state your full names and the capacity in which you appear here today? I'll start with you.
My name is Laura Broughton and I'm Head of Platform Business for Suncorp.
My name is Michael Miller. I'm the Chief Executive for Suncorp's Commercial and Personal Injury Business.
Okay. I now invite you to make a short opening statement, and at the conclusion of any remarks, I'll invite members of the committee to ask the questions. Actually, before you offer your opening remarks, I might just make prudent, for the sake of Hansard, who is appearing here before you in front of the committee. So if I could start with your introduction, Senator.
Senator Paul Scar from the beautiful state of Queensland.
That's it. Scotty Buchholz, the Honourable Scotty Buchholz. I'm deputy chairing the proceedings today in absence for our chair, Senator Deborah O'Neill, who has prior engagements.
David Moncrief, member for Hughes in Southern Sydney.
Thank you, and of course we're joined by Committee Secretary Ivan Powell and your associates, who will ensure the accurate proceedings are for today's event. I now invite Suncorp to make an opening statement.
Thank you, Chair. Chair, committee members, thank you for the opportunity to appear today. Suncorp is a proud Queensland headquartered insurer with a heritage back to 1902. Through our brands Vero, which is our dedicated business insurance brand, GO and AAMI, we insure almost 200,000 small businesses across Australia. We are not the biggest player in the market, yet offer national cover across a broad spectrum of industries, including tailored products such as market stall insurance and business at home for small and micro SMEs. Small business and not-for-profit organisations are under real pressure. Insurance costs have risen significantly since 2019. The average small business premium has increased by over 60%. A policy that cost $2,000 in 2019 costs roughly $3,200 today. Our Vero SME Insurance Index, which is attached to our submission, gives us a clear and ongoing view of what small businesses face year in, year out, drawing more than 1,500 Australian business decision makers each year. It shows 6 in 10 smaller businesses have seen premium increases in the past 12 months. At the same time, 47% report declining revenue. I can certainly understand that those pressures together are hard to absorb. We believe that the commercial insurance market is competitive. There are nearly 400 providers offering general insurance in Australia, including more than 300 specialist underwriting agencies. Small business can buy directly from us or through brokers who help them navigate the market to find cover suited to their business. Small businesses have real choice, but choice alone does not solve affordability or availability. To understand those challenges, it's important to be clear about what is driving premium pressure. The main driver of premium pressure is the cost of claims, especially the expected future cost of claims. That reflects high repair costs, labour shortages, inflation, social inflation, and claims frequency, and the risk profile of a business or industry. In liability and long-tail covers, it also reflects how complex a claim becomes, how long it takes to resolve, and the resources needed to manage it. We are careful not to overstate any single cause because the drivers are multifaceted. If we want to improve insurance affordability, government focus should be, in our view, on 3 areas. Firstly, mitigation. To bring insurance costs down, we must reduce the underlying risk. When governments invest in levees, dams and flood diversion channels, they reduce physical risk for every business in that catchment. Premiums follow. The Roma flood levy is a clear example. It protects homes and livelihoods and puts downward pressure on insurance costs in that region. Second, taxes and charges. Depending on the state or territory, government taxes and charges add between 20% and 40% to the cost of a premium. On the $3,200 premium I mentioned, $715 is taxes and charges, up 63% since 2019. In New South Wales, the Emergency Service Levy collected $1.3 billion directly from insurance customers in 24-25. It adds on average $633 to a commercial building and contents policy. These taxes penalise businesses for protecting themselves. When costs rise, businesses reduce protection. Our survey shows 11% avoided increasing their sums insured and 8% reduced their coverage altogether. They are underinsuring, not because they want to, but because the total cost is too high. Removing inefficient states' taxes and charges and replacing them with a fairer regime would deliver an immediate reduction in what small businesses pay. Third and finally, regulatory burden. Small businesses do not have compliance departments. A cafe operator trying to open in Victoria must navigate 36 separate licensing requirements before serving a single coffee. The Australian Institute of Company Directors estimates Commonwealth regulatory compliance alone costs $160 billion a year. Every dollar spent navigating that load is a dollar not available for investment, risk management or insurance. We note the federal government is examining this issue, which we support. Our research shows 8 in 10 small businesses have never conducted a formal risk analysis, not because they do not care about risk, but because they are consumed by duplicated and overlapping regulation. Finally, the price of insurance is one of the clearest signals of risk in the economy. We should try not to mask that signal, but we can reduce the underlying risk, remove unnecessary taxes and charges, lighten the regulatory road that drains small business of the capacity to protect themselves. Suncorp is committed to working proactively with this committee and government at every level to help deliver that outcome. Thank you, Chair. Laura and I welcome your questions.
I thank you, Mr Miller. And just for the record, it's poignant that we offer our appreciation for your organisation opening its doors this morning for us to have a bit of a look at your data centre and understand with a bit more clarity how your organisation captures its data. And I want to start there. The intent of this committee is to understand one way or the other why we've seen such an astronomical increase far beyond CPI, far beyond any inflationary headline rate. And we'll use since 2019, even back since 2010 as our starting point. And just with the couple of moments I've got with you this morning, I want to understand how do insurance companies generally, and I know you can only speak to how your business prices its premiums. Can you just give me an overview as to how you start layering up what your data sets look like before you head off to your underwriters and what that world looks like?
Absolutely. I'll start, then I'll hand to Laura to give you a bit more detail. I'll focus on the small business insurance portfolio because I think that's the most relevant. So as I said, we insure more than 200,000 businesses. And so there's 2 factors that go into pricing on the whole. One is occupation. So we have 4,000 ANZIC codes and we price down to one of those 4,000 ANZIC codes. And the second is location. So depending on where you are in Australia, the risk, the flood mapping and the like, there's a load for that. So they're the 2 primary parts. And then what we do is we collect data. So internal sources of data from our own actuaries on claims that we have seen, external sources of data such as flood mapping, and the like. So that gives you the overall frame. And then a lot of the small business insurance is done automatically currently. And so from a broker, there'll be straight through processing to us, and we will then use our algorithms, all that data, to price it. Do you want to add in terms of coverage of the market that we have?
Yeah, so we have a very broad portfolio at Suncorp in our small business portfolio. So we have a broad geographical footprint, and we also have a broad occupation footprint. And Michael's mentioned they're two of the key factors that we utilise in terms of risk. We find that having that breadth is very key because it gives the portfolio more stability. And on average, we quote for about 70 to 75% of every piece of business that's put to us. And that's one of the higher quote rates in the marketplace. So that would be 3 in every 4 bits of business that come to us, we proactively put a quote out for. As Michael's mentioned, it is predominantly traded online, so our underwriters really only intervene if there's something unusual or non-standard that, for example, a broker wants to talk to us about. So the broker would key in the risk information with a dedicated online question set. The algorithm will then respond, and as Michael's mentioned, there's occupation, geography, there's the limits that the customer has requested, there's the sums insured that they've entered, there's up to 12 covers they can select under a business package insurance, so they might have one cover, they might have all 12, and also we take into account claims experience, and so then that all produces a quote that would go back predominantly to the broker. Most of our business is traded through brokers, and that quote would then stipulate the quote, which is the price. It would also include any terms we might put on that insurance, so any restrictions on cover or any requirements we might have in terms of, normally it relates to health and safety or ways of working that minimise risk.
What percentage of your business or the industry would have exposure to business? Is it 80% of your business? Is it half your business?
So what we look after in commercial insurance, it's exclusively commercial business. So it's small business, large business, and intermediate business.
When I look at the Suncorp family.
Oh, okay, fine.
So.
Yep. So our premium in the whole group is about 17 billion, and our commercial insurance premium is about $2.4 billion.
So what as a percentage would that be? Relatively low.
25%, thereabouts. And 12%, sorry, I've got my maths. And the key thing I would say around the commercial insurance industry is it is fairly fragmented. So we're number 4 in terms of market share in Australia. And so the highest market share, these are our numbers, sit with QBE, who has about 18%, then CGU, Allianz, and then Vero, or Suncorp, sitting at about 9%. So you can see from there, it's quite fragmented. And as I said before, there are 400 different insurance companies or underwriting agencies in Australia who specialise in that. And just to make one point, Laura said we quote on 75%. You know, that means that we don't quote on another 25%. We can't quote on all professions. And the reason for that is, as an underwriter, you need to be a specialist. You need to have the data to back it up. It's very data driven. There's some areas of the economy which are better off served by specialists in those areas. And so there's no one insurance company that can write everything, because if you start to underwrite businesses that you don't understand, then effectively you don't have the data and you'll misprice it. And either that means that you'll have too high a price or too low a price, and you'll give the wrong outcome to the customer. So I think that's an important part in terms of understanding which competitors or which parts of the insurance industry operate in which areas.
So if we're looking at roughly 12% of your business is that small business portfolio, where's the rest of it? Where's the rest of the pie?
So the $17 billion at Suncorp, right?
Yep.
So our biggest business is in home and motor,
Yep.
which, you know, from a domestic point of view, that's the largest part of Suncorp. And we also write a large amounts of business in New Zealand. So Suncorp is an Australian and New Zealand business, and that's where we underwrite, and that's where we have our specialisation.
Why, you know, if mums and dads that have maybe listening to this evidence today are sitting there pulling their hair out going, ask them why my premiums have gone through the roof. Ask them. It's a great opportunity for insurers to share as to why mums and dads have seen continual increases upon increase in insurances, and I think your comment, Ms. Broughton, around we now live in an environment where I think most people are underinsured. But why are insurance premiums going up?
And we tried to address that in our submission, Chair. So, as I said in my opening comments, it's a multifaceted driver. So the main driver of insurance costs going up is claims cost. And so why are claims costs going up? And so obviously there is the weather. We're seeing an increasing incidence in weather activity across Australia the last 10, 15 years, if not longer. And so the cost of rebuilding communities, the cost of reinsurance has increased. Secondly, inflation. So if there are pockets of the economy that don't have a surplus of capacity, construction is one. There's heavy construction within Australia, in Victoria, infrastructure, New South Wales and infrastructure, and also in Brisbane in terms of the Olympics coming up. And so to get qualified trades, get them on the ground, is costly. And for anyone that's renovated a house, they would see that. And then there's general inflation as well. There's parts, there's inflation in the economy, it's demand. So it's multi-factor. And then in our submission, our second recommendation is taxes and charges. So every time we add $10 to the price of a premium, that's escalated through, processed through the taxes and charges. As I said, that ranges from 20% up to about 42%, depending on which state you're in. And
can we tease that out? Because you did mention that there'd been a 63% increase in taxes. Can you just tease out what those taxes are?
Sure. So each state does differ. And so what we have is we have 3 taxes that go on to insurance premiums.
Yep.
One's the emergency service levy, which is levied in New South Wales and Tasmania, and they're between 22 and 25%, and that's levied on top of the underlying premium.
Yep.
Secondly is GST, which is 10%, which is the federal tax.
Has that ever changed?
No, it has not.
So it was GST, it was 10%.
Correct.
A couple of decades ago. Still 10% today.
Whenever the GST was put into the Australian economy.
Yep.
And then stamp duty is the third one. Stamp duty by state is between 8 and 10%, depending on your state.
And has that ever changed? Stamp duty rate?
It has. The ACT abolished stamp duty.
It's gone backwards.
Well, it's levied now at 0, and so they've actually taxed in a different way. And that gives you effective tax rate. And they're layered. And so you get your base premium, and you add 25% if you're in New South Wales, you add 10% for GST, another 9% for stamp duty, which gives you the 42%. Now, all of those taxes and charges are crucial to the economies of Australia, crucial to the states in terms of maintaining it. We're not asking to abolish that revenue. We're saying it should be levied in a different way. And there's a couple of examples I can bring out. So, number one, if you buy insurance, you pay all those. If you don't buy insurance, you don't. But I would argue that you still use the same infrastructure, the same emergency services that anyone else. And secondly, and this is from an equality point of view, and I think it comes to the heart of the Commission, you'll see a lot of submissions from high-risk industries. And so why they're high risk, it could be because of the geographical location, or it could be the occupation or what they do. And so if you're in a high-risk industry, your base premium is going to be much higher than a low-risk industry. And so what happens then is those higher risk industries get those layered taxes on top of it. So it effectively exacerbates the impact of those taxes and charges on the areas of the economy where access to insurance is more difficult. And so our view would be, if you can find a more egalitarian way to levy those taxes and charges across the businesses in Australia or the ratepayers in Australia, I think you'll find that the impost of insurance is lessened, particularly in those outliers.
I understand the emergency services situation in New South Wales, which is a statistical outlier. But can I put to the insurance bodies another way of keeping those taxes low is don't increase your premiums? It'll get exactly the same result.
Correct.
Thank you. I just want to acknowledge Mrs. Jarrett, who's joined us here this morning.
My apologies for being slightly late, Chair.
I'm sure your impact will still be as powerful as... I just want to give Mr Moncrieff MP the opportunity to ask some questions, and I'll go to Senator Starr. Dave, give the call.
Thank you, Chair, and I want to acknowledge, as the Chair said, or the Acting Chair said, that the efforts you put in this morning to take us through the data that you've got, it was really insightful. So thank you for that. On the subject of data, I just wanted to touch on with the small business sector. You said in your submission that the small business sector is more likely to have the informal ad hoc approach to risk mitigation. I just wonder whether you could talk through whether you've got an approach to trying to gather data on what risk mitigation small businesses have when they're taking out insurance with you, whether you've got any approaches to gathering that information.
Absolutely. I'll start at a high level because I know data has been part of the inquiry's outcomes, and I'll go to Laura on the individual. So in some parts of insurance, we have excellent data. And the problem is getting to the data more than anything else. So if I can split it into three, if you're a small business in Australia, you'll buy workers' compensation, you'll buy effective property and liability, which Laura can talk to, and you'll also buy a compulsory third party. And just to illustrate some of the complexity there, if you're buying workers' compensation in Australia, they're all levied by the states and their schemes. And so effectively you have a gazetted rate, and you can charge so much per occupation, and that gazetted rate is set by each state. In Western Australia, Northern Territory, Tasmania and the ACT, all of those schemes are underwritten by private enterprise, so Suncorp participates in all those schemes. But if you go to Queensland, New South Wales and Victoria, it's underwritten by government, and so we don't have access to that data. As part of participating in those schemes, we give expansive data files in terms of claims, types of claims, psychological impacts and the like. And so there's a richness of data at a state level. We get access to what we have, but we don't have access to all of the data for the industry. In compulsory third party, a similar situation exists. So in Queensland, New South Wales, South Australia and the ACT, those schemes are run by government, also privately underwritten. And so Suncorp participates in those schemes. As part of that, we give all of our data in terms of claims to the authorities. In the other states, Victoria, for example, and Western Australia, it's underwritten by the government. And so they have all their data there and we don't have access to it. So you can see there, hopefully, in terms of having the federated states, there's different data sources. The key is how do you get all that together in one place, which I think will give you a really good view of psychological claims, litigation costs and the like, and not listening to people's views. The data's there. To give you a little bit of an idea of some of that, we try to pull, and the final one is APRA, which is the National Claims and Database. And so give you a bit, we've gone through those submissions and trying to give you a bit of a snippet. So CTP in New South Wales, CIRA is the regulator there. Yeah, they've had record high lodgements in Q3 25 of 3,900. Average payments per claim after 4 quarters is 20,000 in 2025. It was 10,000 in 2018, so a doubling in that 6 or 7 years. And the drivers they state are increasing payments to psychological, along with imaging and physiotherapy, and the removal of the 20-month damages waiting list. So you can see some independent verification of that. It's fair to say if you're a large corporate and you do large-scale mitigation, we will recognise that absolutely in the premiums. We have about 30 risk engineers who will go out and survey large corporates, make sure they've got sprinkler systems adhering to the like. When it comes down to the smaller side of it, where the premiums on average are around $4,000, that is much more difficult. And I'll give over to Laura in terms of question sets, how we try and address that.
Thank you, Michael. So as we've mentioned previously, most of small business insurance is transacted online with set question sets. We definitely include in those question sets questions about risk mitigation or aspects that might bring the price down. An easy one and an obvious one is building materials. Obviously, if your building is made of bricks and tile roof, it's going to attract a lower price than if it's a wooden building. But we also ask questions about if you've got sprinkler systems, fire alarms, burglar alarms, etc. And all of those aspects, if declared, definitely bring the price down because they help mitigate the risk. We also, as mentioned, do most of our commercial business through brokers. And brokers play a really valuable aspect there of being eyes and ears that we can't possibly be with the tens of thousands of small businesses that we insure. Brokers will often go and visit the small business, so they'll go and look around the cafe, the pizza shop, the clothing shop, and they'll sort of be our eyes and ears in terms of not only getting a good assessment of what needs to be insured, but also at times they'll give the customer advice as to how they can improve their risk, and they'll also have a chat to some of our underwriters if they think there's something there that's material about the risk that we should know that perhaps our online question sets won't cater for. we always encourage our brokers to give us a call and we'll get our underwriters to have a conversation. So there's a few different ways, I suppose, that we can get across the risk mitigation data. It definitely does vary from small businesses to the larger corporates that Michael's mentioned, where we can send a risk engineer out of our own and they will conduct a full survey of the risk and then make recommendations. So it really does vary between that, I guess, that gamut of commercial businesses where you've got the very small down one end, maybe only paying a few $1,000s in premium, up to the very large corporates.
And is that something that you do? Do you communicate with the brokers or through your direct insureds as well around what you would like to see in terms of risk mitigation? What's best going to help them with risk mitigation, or is that something you rely on the brokers' knowledge of the industry to communicate?
We don't give advice, so we have to be particularly careful there, and that's where the broker is much better placed to advise the customer. They play a really valuable role in being that intermediate between the insurer and the customer, and often they're much better placed to give that and give advice.
One thing we do is we get our underwriters out to talk to the brokers and make sure they understand what we like in terms of risk and where we don't like risk, and what are the things that they can do with their clients to basically reduce their risk. So it's more of an information session in terms of these are things we're expecting,
Right.
And then the brokers pick that up and they give advice to their clients.
Yeah, great. Okay, cool. And is that, how bespoke does that become for each class of business? Or is it just a broad sort of, this is what small businesses, the risk they're seeing?
It will depend on the industry.
Yeah.
And so, it's been talked about here before, tobacconists, for example. Tobacconists is a very tricky part of the economy right now to insure. And the reason for that is there's illegal activity in that area. Interestingly, though, I think with tobacconists, it's not only the tobacconist itself that we have problem insuring, but if you have adjacent shops to the tobacconists, because there's incidents of fire bombings, that can also increase the risk of the shops around it. So part of our job is to make sure that the brokers understand that risk is something that we are very worried about, not only for that one shop, but perhaps the shops or the strata around it. And it's an education session in terms of communicating. We try and communicate really broadly with our brokers because they've got 400 different markets to deal with. They need to understand who likes which risk and where to go to. Otherwise, it's a waste of their time, and they get quite good at that. And as I said, a lot of good relationships between us and the brokers, training, ongoing training in terms of our product set, what we're seeing and the trends. And the brokers equally have good access to data, and they at times educate us in terms of what they're seeing, and they can convince us to change our mind at times in terms of the underwriting risk.
Cool. Thank you, Chair.
Thank you. Senator Scarr.
Thank you, Chair, and welcome to our witnesses from Suncorp, a great Queensland company with a wonderful Queensland-based heritage. And thank you very much to Mr. Miller and Mrs. Broughton, your staff, for their excellent work in terms of organising that tour this morning of Suncorp's leading facilities. That was really impressive, very impressive. I first want to talk about this issue of state taxes and charges. So can you just walk me through on a example, say my premium's $1,000, right, before we apply the taxes and charges. I want to just understand how the compounding impact works. So assume the base is $1,000.
$1,000. So the first thing is, if you have ESL, which New South Wales and Tasmania does, between 20 and 25%, you apply that first.
Okay, so that takes it. So the emergency services levy, so
1250.
So let's assume it's 25%. So that takes us up to 1,250. So that's the first compounding effect.
Correct.
Then you add the next one.
Then you add 10% on the 1,250.
So it's the GSTs then applied.
Correct.
Which is another $125.
Correct.
Yeah.
And then you add stamp duty. I'll pick New South. I'll pick WA because it's 10% there. Another 10%.
So that's applied
on top
to
of
the post GST.
1,250 plus 125 together.
So that's the one. So that's another $137.50.
Correct. Which, depending on the state, will give you a cumulative impact. New South Wales 42%. Down to the ACT, where it's 10% cumulative impact.
What's the stamps in Queensland?
9%.
Okay.
So there is a real inequity there in terms of people who are, and you described it in your submission. I actually noted the phrase that came into my mind before I read the entirety of your submission was a tax on resilience.
Yes.
And you actually use that phrase in your submission. So the more you're protecting your assets and being less of a burden upon the greater community to assist you if you get into trouble, the more you're taxed. And the less you're providing risk mitigation for yourself and your family and your own business, the less you're taxed. That's the situation at the moment, isn't it?
Correct.
And there's this compounding effect of two different, in a number of jurisdictions, the two different state or territory taxes and levies, and then the GST.
Correct.
And so it's a tax on a tax.
Correct.
Right.
Well, and just for New South, I know the New South Wales have announced, they're looking at the ESL levy and a more equitable way to levy that. They need that income stream, which we understand. It's just how you levy it. And so New South Wales are looking at it. So if New South Wales solves that, then you'll be down to Tasmania, which still has an ESL.
Okay. And what do other jurisdictions do in terms of, say, New Zealand, or do you have any insight into New Zealand as to whether or not they have the similar tax regime? I'm just interested to know what other jurisdictions do in terms of trying to address this. And feel free to take it on notice.
Well, I can't answer that question.
I don't know about New Zealand, no. The ACT was the main example that we'd looked at where they've removed ESL and stamp duty. And
so ACT have removed both stamp duty and ESL, so there's just GST,
which is federal tax.
on the levy, but the ACT has a general land tax.
Yes.
That they apply across the board. So presumably that's one of the ways in which they raise the revenue. So everyone contributes.
Correct.
Okay.
And the ESL's been around since the 1880s, I think. A long time ago, insurance companies paid for the fire brigade. And therefore, as part of the insurance premium, there was a levy in there. And when it switched over to public ownership, the ESL came across.
Okay. You spoke, Mr. Miller, you spoke about different businesses, some businesses, because of their type or the occupations, having greater difficulty to access insurance. You gave the example of tobacconists, which is a pretty evocative example. We're seeing why the risks there every day. Are there any businesses, putting aside the tobacconists, where Suncorp over time has withdrawn coverage? Are there any examples you can give us?
There are. There's quite a few. Do you want to give a feel?
Yeah, there's a number of industries or segments of industries that we don't participate in purely just because it rocks the portfolio too much. And if we continue to participate in them with the claims that we see, we'd end up having to put up costs for everyone to be able to meet our liabilities.
So, Mrs. Brown, in particular, I'm interested in areas where you once provided insurance, say over the last 10 years, 15 years, and you've withdrawn from the market.
Tobacco is the only one that we've done recently. We don't do it often and we don't do it willingly. We try and pull all our other levers first, whether it's pricing levers or higher excesses or mitigating maybe the levels of sums insured who are willing to write. We try and pull all our other levers first because it's not good for the marketplace as a whole to have insurers moving in and out of segments frequently.
Yep.
So we, and I think most other large insurers would say, we don't do it easily or quickly. We try and look at every other option first before we move out. And even with tobacconists, we stopped writing new business last year, but we kept on our existing policies in the hope that maybe we could still participate in tobacconists with keeping our existing customers and offering renewals, but we just wouldn't write any more. Unfortunately, we're now a year on and we're having to pull out of those two because it's just not sustainable. But hopefully that shows you and demonstrates a bit of just how much we try and do everything we can before we actually have to exit an industry.
And I can give you some examples of areas that we find difficult to underwrite. So islands off the coast of Australia are difficult for us to underwrite, just the pure cost of rebuilding because of the barges and the like going out there.
So in particular there, Mr. Miller, we're talking about islands that might have tourism resorts?
Correct. North Queensland, absolutely.
So you won't provide coverage?
Correct.
In that respect?
Correct. We did up until about 2016 in Cyclone Debbie, and there was a lot of
So are you aware whether or not anyone in the marketplace is offering, I mean, obviously that's a big issue for the tourism industry in Queensland. Are you aware as to whether or not any insurers are offering?
They can get in. Well, I'm not an expert, but I think Lloyd's will do some of the island business.
Right.
You know, we have looked at Tangalooma off here and offered terms there on the southern side. But the general problem, the issue for us is just trying to predict, you know, one, the severity of storms that are coming through, but secondly, it's just the cost of rebuilding, using barges, labour, getting it to that area. Tattooists, which I think came up before.
Oh, sorry, just before we move off islands.
Sorry, yep.
So there are islands and islands.
Correct.
Right. So there's Hamilton Island, which, just picking an example out of my head, which is obviously a tourist destination.
Correct.
There's also, say, some of the islands in Moreton Bay.
Correct.
Are you still insuring some of those islands in terms of North Stradbroke and destinations like that, or islands like that?
I believe so, but I'm going to have to take that one on notice. But I can tell you Hamilton Island we don't.
Yeah.
We did up to 2016 and then we stopped. Russell Island, the like in Moreton Bay. It's on the home side more than the small business side. So if I can get back to the answer, I just don't want to give you the wrong one.
I'm just keen to know, especially wearing my Queensland hat as to
absolutely
when you make that comment. So we've spoken about islands. The next category,
high risk occupations. So I said the two points for us is one is geography and the second is high risk occupations. And so tobacconists we brought up, which we've recently changed. Outdoor activities. Caravan parks with jumping pillows, where you get large liability claims. I think the tattooists that came and gave a submission the last. We don't underwrite tattooists because it's very specialised. It did have a history, but also we're more of a generalist. You know, where there's a piercing of the skin, we find that from our point of view.
Risk issue under liability.
So are those markets you've withdrawn from, or you simply have never written?
A combination of both. So I think the islands we've withdrawn from, tobacconists we've withdrawn. Going back, tattooists is 10 years ago, so I don't have that knowledge to hand.
Caravan parks?
Yeah, caravan parks, I think it's the liability side of coming out of caravan parks that worries us. Outdoor activities.
So have you withdrawn from caravan parks? Or?
I think there's a question set where we can underwrite it, but if they have activities that we think are high risk, then we wouldn't underwrite them.
So what's an example of an activity?
Jumping pillows, which my kids used to love.
What's a jumping pillow?
It's a
You're just showing your age, mate.
Sorry, okay.
another
Go take your
example,
kids to caravan parks, they are great.
swimming
half the size
pools
of
with
this.
slides.
Like a jumping castle thing?
Yeah, it's an elevated platform like a jumping castle.
Sounds fun.
Yeah, they love it.
It is until
They kill themselves on it.
And so, again, coming back to the tourism industry, there are tourist activities, parasailing, a whole list of things I've never done in my life, which tourists might be interested in doing. Have you withdrawn from those sorts of areas?
I'd say a lot of those types of risks are not suitable for a small business package policy, which is what we've been talking about to date, because that normally caters for quite homogenous risks with quite a limited question set. There'd be a more complex risk that we might pass to our tailored underwriting team, because you need to have a real understanding of the risks involved, the activities, etc. So it's not that some of those aren't insurable, it's just they're not suitable under a small business package insurance, which is quite a standard product.
Okay. Last question. In terms of, we talked about the successful mitigation arising from the construction of the Roma flood levy. How important is it that when we're looking at those, that mitigation expenditure, including the application of government funds, investment into those mitigation assets, how important is it that there's close liaison with the insurance industry so that we can understand the potential impact on insurance levies? And if I can put it another way, how do we go about ensuring that those mitigation assets don't just have an impact in terms of the direct impact, in terms of stopping flooding or whatever it is, but also it flows through to insurance premiums so that we're getting that benefit for the community?
Our number one recommendation is mitigation, particularly in Queensland, where we have a large market share. We've seen in cases like Roma, where it has been successful, and we've seen in some cases where arguably it hasn't been successful. So number one, we're recommending mitigation. If mitigation is undertaken, there's two outcomes. One, the risk is reduced, so you get less claims. Number two, the cost of insurance should reduce. So I think that's absolutely the imperative.
So how do we achieve the second?
So the ICA testified at the last submission, and so what's happening now is mitigation projects are being given to the ICA, and the ICA then goes out to the large insurers in Australia, puts it through their flood mapping, their modelling, and then comes back with an outcome of what that is. I think it's really important that not only one insurer participates in that, because you need a market. So if one insurer thinks that an area has been mitigated, but the rest of the market doesn't, you just have too much concentration in that one area. So I think what the ICA is doing with that process of get the plans, run it through the insurers, look at their modelling. Yes, that's on average it'll achieve X reduction in that risk. That's the right process. As I said before, an outcome of mitigation that's undertaken where the insurance industry doesn't recognise it is not a good outcome for anyone involved. We need to encourage it, and I think it's vital, particularly in Queensland, but more broadly across Australia.
Okay, thanks very much. Thank you, Chair.
Ms Jarrett, welcome, and
Thank you,
you have the
Deputy
call.
Chair. Thank you. I just want to pick up on a comment from Senator Scarr in relation to potentially uninsurable businesses or areas where you've walked away from. But you, Ms Braun, said we're talking small business packages here. So are they insurable under other packages? So if you take your tattooists or your Outdoor Australia or Scouts, we had the Scouts come in and tell us how difficult things were. Are there different ways that they can be insured?
There's probably two other avenues they could be insured. So there's what we call tailored lines or complex underwriting. So that's generally bigger risks than small businesses. And they're written normally manually by an underwriter who conducts a risk assessment. They might send out the risk engineer that we referenced earlier. And it's a more manual and involved style of underwriting to really understand the risk that's presented, and then the insurer can assess whether they want to participate. That's an option for a large composite insurer like ourselves. And there's also a number of insurance agencies in the market that might have specialisms to one or more of those higher risk options, where they'll seek to write a large number of that same type of risk, and get some benefits from having that specialist knowledge in terms of how to underwrite them that perhaps an insurer like us that tries to write across the whole spectrum wouldn't have, that they would have, because that's all they focus on.
I think, in my opening statement, it is competitive. There's 400 insurance markets in Australia. There'll be domiciled Australian insurance companies, overseas insurance companies, and these specialist underwriting agencies, which are often backed by Lloyd's. And so a lot of the specialist underwriting agencies will pick one area and understand that intimately and put it together as a package, working with industry. Industry will then have a series of standards. They can put all their claims data together and they can package that up and say, to Lloyd's, for example, this we think, if managed well, is an acceptable risk. And that's why it's so important that the industry is competitive. It's so important that we do have many participants. But I think it's really important from our point of view, one insurance company can't do everything, because what happens is you have too much concentration. And as I said before, we can't be specialists in everything either. We're a large insurer specialising in Australia and New Zealand, but we quote 70 to 75%, which means that there's 20% of business that we will not underwrite.
But that industry approach that you're talking about, though, like how widely is that utilised? And is that an avenue or a channel for better access to insurance force? I appreciate it's for certain sectors, but is that something that is just sort of floating there, or is the industry, insurance industry, looking at that and saying, okay, we really need to be doing more in this space to give more high-risk areas access to insurance?
So
I know it's not necessarily your bailiwick, but you're in the market.
Yeah. As I said, there's 4,000 ANZIC codes, so it's industry standard. You rate by occupation, because each occupation has a different risk. Some are higher, some are lower. So that's very standard. And all of our modelling, all of our data is collected by occupation code, and therefore we can work out there a technical price. The technical price is what we think the claims will be, based on the history, and then based on inflation going forward, and also what's happening in the industry. From the technical price, then we'll put one out, and that's how it works in practice. Our job, in terms of what our view in terms of addressing the affordability and availability, is back to our recommendations. Number one, particularly around mitigation, which is location or geographic or peril. We think that's the number one. And number two, with the taxes and charges, again, the high-risk industries have the highest premiums. They pay the most taxes and charges. So if you can address that and make it more equivalent, it'll take the load, if you like, off those high-risk industries.
Okay.
And the final thing is, we are proud to be an Australian company. We do want to grow. If we do see pockets where it makes sense for us to be in, we're always looking for them. But it's a matter of getting the data, be presented with that and making sure we understand what we're doing.
Okay, could I, time for one more? Just in terms of you said 12% of your portfolio is SME, correct? Did I hear that?
Business.
12% is commercial as a whole. SME is a part of that.
Okay, commercial as a whole. Okay, just like help me understand. In the last 5 years, what percentage are claims increasing? Because I read somewhere not that long ago, and I think it was in the Vero index. Was that yours? Where it said a lot of the businesses surveyed in that survey actually hadn't put in a claim in the last 5 years.
Yes.
So if there's no claims going in, how can the cost be going up?
Correct.
Just asking the question.
No, absolutely. and that's, I guess that's the concept of insurance. You have a portfolio of like risks. Some will have a claim and some will not. And then as a portfolio, they share effectively the cost of that. Our calculations in our submission, we've got a 60% increase in insurance premiums on average since 2019.
I saw that, yeah.
And as I said before, it depends on the occupation, depends on the location, but it's not. But also, it's a general inflation in the economy. And so our job, in many ways, is to make people right in terms of property or in terms of damages. With wage inflation, in terms of personal injury. There's the cost of materials, there's the cost of labour, all of that then floats into it. So in many ways, the insurance premiums just mirror what's going on in the general economy in terms of our pricing.
So if we look at a 10-year period, say 5 years prior, no new claims lodged. So therefore, any of those price increases that you're talking about are coming from claims previously that obviously have to be carried across. And I understand how it works. But then, so going forward the next 5 years, are you still going to see zero claims?
It depends. So from a portfolio point of view, we always get claims.
No, okay.
So, but an individual,
Yes.
as a homeowner, you may not have a claim for 20 years, which is fantastic, but you're still going to get price increases because your neighbour or your neighbour's neighbour have made the claims. And so we look at it as a pool and look at the cost of that pool, and then we actually put it in. And it's a transfer of risk to us. We have to look at it from a portfolio point of view, because if we get too granular, some individuals who, for no fault of their own, will get large increases, and some individuals, by happenstance or good luck, will get no increases because they haven't had a claim. And so that's just the general principle of how that will work.
One last question. Do you have a point of view on this 20 million public liability insurance? Because a lot of the not-for-profits or volunteer groups are saying that this is very costly for them, and it seems to be becoming an industry standard to have that level of liability cover. Yeah. And who's driving that? Is it the insurers driving that just generally, or?
We offer, this would be in the public liability space.
Yep, public liability.
So we offer 3 limits that customers can buy. We offer 5 million, 10 million and 20.
Yep.
If I look at our direct book and we see what people purchase, it's split really a third in terms of what people are opting to take. If I look into our intermediated book with brokers, where you typically see slightly larger, more complex SMEs, it's more 60% at that highest level and about 30% at the 10 million, and then just a handful take the 5 million. So we do see quite a distribution of people deciding to purchase the different limits. We certainly don't make any recommendation as to what limit people buy. We allow them to buy all 3, and it's really up to them what they choose to purchase. So those recommendations of 20 million seem to come from companies or organisations that small business is working with, and they've deemed that the minimum level that they'll accept. But certainly not driven by us, and we offer 3 limits.
You just said though that brokers, where there's more brokers, you're getting more towards the higher end. Do they get the commission for that?
Brokers and commission as a percentage on premium, but brokers ultimately represent the customer, and they're advised to represent the customer's needs, and so they would judge that the customer would need that levels. And as businesses get more complex and get larger, it would be natural you'd see them needing the higher limit more often.
Correct.
Thank you, Chair.
Thank you very much. Well, I'm conscious of time. Thank you for your time here today and giving evidence. I know Senator Scarr asked a couple of questions that you've taken on notice. If you can get that back to the Secretariat by Wednesday, 15th of July, you have all those details. Thank you for appearing, and thank you for your hospitality this morning, and we'll welcome our next... We'll take a short break, just for a few minutes for broadcasting to lock and load, and we'll welcome our next guest.
Thanks very much.
Thank you.
Oh. So, welcome. I understand that the information on parliamentary privilege and the protection of witnesses giving evidence to the Senate committee has been provided to you.
That's correct.
For the Hansard record, could you please state your full name and the capacity of which you appear today before these hearings?
Sure. Dr. Amanda Jane Bull. I'm a lecturer at the Queensland University of Technology, and I appear in that capacity.
In that capacity? Yeah, wonderful. Now, I normally sometimes will get people who appear in their personal capacity, but that's creating a little barrier of...
All sorts in this committee.
Absolutely. I now invite you to...
Confused now, Chair.
That's it. It's exactly. I now invite you to make a short opening statement, and at the conclusion of any of those remarks, I'll invite members of the committee to ask you questions.
Great, thank you. So today I thank you first of all for the opportunity to speak. I'm drawing largely from funded research that members at the QUT have undertaken as part of the Building 4.0 CRC funded project, looking at why insolvency is so high in the residential construction industry and what can be done about it. Drawing from that research, we found, of course, the construction industry is hindered by systemic risks. But for today's purposes, we're looking at insurance. What we found is predominantly business operating in the construction space are small businesses, and that's in the Australian residential construction space, I should say. So they are small businesses. They're operating with incredibly thin profit margins, often as a result of the regulatory framework in which they operate, the financing framework in which they operate, and generally speaking, the fact that they are small businesses and they're in the construction industry, which are historically and well recognised as high risk. Now, the reason why they have these thin profit margins, like I said, there are financing restrictions because they are considered high-risk businesses. They are operating within regulatory frameworks, so they've got limited access to funds because of progress payments. So these are quite lumpy payments that are made throughout the construction process, but they're often burdened up front with having to take out insurance and other costs, but they're paid retrospectively at the first progress payment. So there's a lot of moving of funds around different projects. And so that is inherently risky, because if something goes wrong on one of the previous projects, maybe out of their control, like a minor defect, which holds up a big progress payment, or litigation that they might be successful in, but still holds up a project, means that there's funding that trickles through, impacts their ability to take on insurance, or they have to move these funds around to be able to take out insurance and other works up front. Now, also, and the key of my research is that when those businesses are in financial distress, if they take a proactive step to access one of the new restructuring regimes in Part 5.3b of the Corporations Act, so this is a regime focused on assisting small businesses to restructure and return as economically viable citizens if they satisfy the majority of creditors that they're able to do so. The problem in the construction industry and with insurance is that if they are taking these proactive steps, their insurance might well be cancelled. And if they're in an industry where insurance is essential for business operation, that means that they cannot carry on the business. So it flies in the face of the ability to access a regime that seeks to restructure that entity when in financial distress. So they're taking proactive steps, but being penalised, if you will. I'm not saying all businesses should be saved, for that matter, but what I am saying is those that find themselves in financial distress are seeking or taking proactive steps to mitigate that risk to their creditors. They should not be prevented from restructuring simply because they're taking those steps and having their insurance cancelled or licences cancelled in some cases as well. I'm open to questioning from the committee.
Mr Moncrief.
Thank you, Chair. Thank you for appearing for us today, Dr. Bull. I just wanted to, you talked in your submission around the impact of cap deposit limits.
Yes.
And the impact of including insurance on that. I wonder if you could just expand a bit on that.
So in some jurisdictions, and the difficulty in the construction industry is each state and territory has different legislation and regulations that govern the industry. So in some jurisdictions, there are deposit caps. So that is the maximum deposit a builder can take when entering a contract to proceed with the construction work. From that deposit cap, or the amount that they are paid, they have to pay all of these upfront costs, including insurance. So what our workshop participants were telling us is once they undertake some of the preliminary works that are necessary to determine whether the project is feasible and they take out insurance, there's a really small amount left for them to actually progress to the next stage of the works.
And sorry, so which jurisdictions have the most, what do the different jurisdictions have in terms of those limits?
Of the deposit caps?
Yeah.
That's set out in detail in our report, and it is very detailed. So I will take that on notice if you don't mind. I can come back to you with the detailed.
But are there specific jurisdictions that you think have the most work to do in this space?
No, I don't think anyone does it particularly well.
Okay, right.
Yeah.
Okay. Okay, cool. All right, cool. So you talked also around this is obviously the systemic underinsurance in the construction sector, and you talked around data sets and enforcement tools.
Yes.
What sort of data sets and enforcement tools do you think would be are most required to alleviate this issue?
Well, currently there's very little data, especially in the insolvency space, about the impact of insurance or what insolvency does for insurance cover for companies that are accessing restructuring frameworks. ASIC data we worked with, but that was not publicly available. We worked with them to do free text data searches of causes of insolvency and in the other field. We looked at other because it was one of the top 3 drivers of insolvency when you look at the statistics, but on the publicly available data you can't tell what that is. Our research indicated that amongst several factors, mental health issues, personal issues, insurance coverage and cancellation of it was one of the aspects that was discussed in the free text fields. Now,
The first 2?
Yes.
What were the first 2?
The first 2 were contract disputes and
Yes.
defects.
Contract disputes and what?
Yep, and defects.
Oh, okay.
Yeah, not surprisingly.
Okay.
So, I've lost my train of thought.
Oh, so
you were talking-
No. So,
you were asking about, your answer was that you were saying that the third
That's
reason
right,
was
other.
in insurance costs were the number
Yes.
3 that you had pulled apart from other.
yes, that's right. Now, sorry, not number 3. They were one of those issues
the other.
identified in the other
Yep.
category. Other was number 3.
Yeah.
Yes.
Do you have a percentage on that? Well,
Yes, I do. Not a percentage, but when ASIC undertook the free text data analysis, we had 340 odd free text fields that were analysed. I can give you the figure. I can confirm that figure later.
Yeah, great.
And of those fields, only a small proportion had the practitioners had filled in the free text fields, because it's a drop-down list they have to choose from. So they're limited and they're time constrained, so don't often fill in that free text field. But of those, there were 9 to 10 that identified insurance. Now that seems like a small number when you think about the overall number of forms that were completed, but the fact that that was actually mentioned in the free text fields highlights to us as researchers that is actually a concern, because as I said, often those free text fields are not filled in. Often, by the time those forms are being filled in, there are so many aspects of the business that have resulted in this insolvency pathway being followed that it's very difficult for the practitioner at that early stage to identify what the actual risks are. So for insurance to be identified there is an issue, I think, worthy of further research.
So what do you think, how can we collect more?
Thank you.
Yeah, what
Yes.
data do you think we need to be collecting?
So I think ASIC and AFSA can work together with
ASIC and AFCA?
AFSA, so the Australian, that's the personal insolvency regulator and
Yep.
the corporate regulator. They both have access to data. I understand that it informs why the builder, in this case, has entered insolvency, whether that be personal or corporate, depending on the legal nature of their business. But also the regulators. So our research was also informed by data that some of the construction regulators obtain from their own annual reporting requirements from their members. And that was incredibly useful in terms of giving context to the very broad statistical data that you get on the public record. So they had particular members, obviously limited in the construction industry. They could narrow their data down to residential construction players in this field, and also had very key data findings from the forms that they require be completed. But of course that's all siloed in different states and territories, and so there's no national data repository that we can look at this data and actually highlight what the key issues are across each of those jurisdictions. So I think if we have industry regulators, more broadly than construction, because we're talking about small business here, but AFSA and ASIC as well, that would really just inform us and provide greater context to what the real issue is.
So what questions should they be asking, and when should they be asking them?
I think, well, I can talk from the insolvency perspective, but I think they should be asking to what do you have current insurance? Or does the company to which you are appointed have current insurance in relation to whatever industry you're operating in?
And is that at licensing? When should they be asking?
From the insolvency perspective, the only time data is collected is when the practitioner is appointed and they fill in those forms for ASIC or AFSA. When it comes to licensing from the regulator's perspective, insurance is a requirement for licensing in most jurisdictions. And so whenever they do an annual check, they should be checking that the insurance is in place. And if not, well, that would be one of the red flags in their early warning signs of insolvency.
Are the regulators not doing that at the moment?
It seems to be a bit piecemeal at the moment.
Right.
They are working towards it, and certainly the East Coast regulators, from our research, they're working quite hard on helping operators and their members by identifying red flags that might indicate insolvency, one of them being not paying your insurance premiums.
Right. All right.
Thank you, Chair.
Thank you. Senator Starr.
Thank you very much. I'm going to get into the weeds of the small business restructuring.
Oh, yes, okay.
I don't think we've really gone into that in a lot of depth yet. And I'm interested in the points you're making in the submission around that. So, as I understand the way it operates at the moment, it's the intention was, and I've sat on previous inquiries looking at the scheme and
Yes.
whether or not it's effective or not. The basic concept is to provide a relatively simple, straightforward opportunity for a small business to restructure to avoid going down the liquidation path, appointment of voluntary administration path. So it's meant to be an intermediary step between having to go appoint voluntary administrators or liquidators or go into bankruptcy to provide a way for a small business with the assistance of a small business restructuring practitioner to try and restructure debts, etc. Now, I'm giving this preamble just so you can understand where I'm coming from in terms of these questions, in terms of my thinking. As I understand it, the rights of creditors are largely suspended whilst a business is going through that restructuring stage. So if I'm a trade creditor, I can't enforce my debt. If there's a winding up application, that's potentially suspended whilst you're going through these restructuring efforts. As I understand, your specific concern with respect to insurance is that there are clauses in insurance policies, contracts, which provide that embarking on a small business restructure constitutes an insolvency event, or however it's defined,
Yes.
and that then gives the insurer an opportunity to cancel the contract. Is that correct?
Correct, yes.
Right. So so if you say comparing the position of an insurance company with, say, a landlord, if a landlord has in their lease an insolvency event clause that gives the landlord an opportunity to terminate a lease in the event that a small business restructure is embarked upon, are landlords prevented from acting on that clause?
So there are ipso facto protections. So ipso facto provisions are those that enable, automatic cancellation upon entering an insolvency event. They prima facie apply to this regime. So a landlord wouldn't be able to enforce their rights under a lease. Prima facie, an insurance company shouldn't be able to either. But insurance comes under one of the exceptions to the ipso facto protections because insurance is seen as a high-risk industry, and also entering into an insolvency pathway is a high-risk event.
So so a landlord's not exempted from the suspension of the ipso facto.
Yes.
It's a great term. Application of insolvency events. Trade creditors?
Trade creditors are not exempted either.
Trade creditors aren't exempted. So someone who's a supplier to a small business, they can't use that insolvency event clause in their supply contracts. A landlord can't. So who are the exceptions in addition to insurers?
Well, there are pages and pages of exceptions. Yeah, there are. You find them in the regulations to the Corporations Act.
Okay. Well, no need for you to. I'm just trying to get and what was just develop your discussion in terms of the thinking of the legislature in terms of making that an exception.
Yeah.
Insurance is high risk, sure.
And entering insolvency, the insurance companies argue that, well, that's a high-risk event for us. How do we know you're going to be able to successfully restructure? And then they say, well, the costs of burdening or of having that risk or bearing that risk as an insurer means that we have to increase costs elsewhere for our insurance policies.
Okay, but you could say the same thing with the trade supplier.
Yeah, precisely. Precisely, on credit terms.
Couldn't say the
exactly.
same thing about trade supplier. So is it all insurance contracts? So I understand you might have D&O insurance, directors and officers insurance, giving coverage to directors and officers of a small business if they're structured that particular way against insolvency risk, insolvent trading. But this exception covers all insurance,
it does.
including general...
It comes under a financial product,
right.
And so it's very broad in its application.
And it
as
doesn't...
I understand it.
So if I provided, if I provided insurance, say, to a construction company, right, that's, and I must compliment QUT on the multidisciplinary approach of your submission. You've got colleagues from all different disciplines that have contributed to this. I actually need insurance to maintain my registration, correct?
Yes, that's correct.
So we have a national crisis, if I can put it that way, in terms of insolvencies in the construction business. If my insurer terminates their insurance coverage because I've gone into a small business restructure, even though I've managed to navigate through it effectively, deal with trade creditors, I could find that my insurance coverage has been terminated and therefore my registration is terminated. Is that correct? That's
correct. And it can also operate in the alternative. So the state or territory regulator might cancel the licence, which then is another avenue for insurers to cancel the insurance.
Okay, so it can work both ways. So it means that a construction business that might otherwise be able to utilise this small business restructuring pathway to remain solvent and operating and, say, continue to fulfil construction contracts, etc.
Yes.
Is effectively prevented from doing that because insurance companies are invoking these clauses to terminate their insurance. Is that correct?
That is correct.
Okay.
And just turning on the licence cancellation for a moment, which can lead into the insurance cancellation, that differs depending on which jurisdiction you're in. So, for example, in Queensland, if you're a construction company, you can successfully enter Part 5.3b because the Queensland Building Regulator, QBCC, interprets what an insolvency event is quite narrowly. So it excludes the small business restructuring regime from their perspective. And I believe Victoria has moved towards that approach as well. But there are other jurisdictions, like in New South Wales, where iCare, that's one of the regulators, regulatory insurance bodies, they will cancel your licence and/or your insurance because they have either interpreted insolvency event very broadly to include all insolvency pathways, including this restructuring pathway, or they have amended their language without thinking about it or thinking of the objectives of this regime to actually include small business restructuring. And the reason why I say haven't quite considered the objectives of that regime is that, unlike any other insolvency pathway in Australia, the small business restructuring pathway allows directors to remain in possession throughout the entire process. In other insolvency pathways, an insolvency practitioner displaces the directors, and so their insurance coverage, can allow this business to carry on while they see what's happening and try and get it back on its feet to either return it to the directors or end up in another insolvency pathway. But the small business restructuring framework allows the directors to remain in possession, so they are in control. They are running this business, but they have the guidance of a small business restructuring practitioner to help them put their best foot forward to their creditors in terms of how much they can pay them and why they should be returned to the economy and allowed to continue running a business in this industry.
So just last question, feel free to take this on notice if you'd like to. I'm interested in any data you can provide us to get a better feel for the number or magnitude of that, I won't call it an anomaly, it sounds like it was intended by legislature, but the impact of that on businesses that are going through small business restructure. So
Sure.
we're talking about a dozen a year, we're talking about 200 a year, just some sort of appreciation of the numbers. And the second question I'll ask you to take on notice, feel free to provide any answer you can to either of these two questions now. The second question is, to what extent has this issue been raised through previous government reviews of the effectiveness of the small business restructure regime? This committee did a very intensive inquiry into insolvency.
Yes, in
during the term
2023.
Sorry?
In 2023?
Yeah,
Yes.
which I was part of.
Yes.
And there was discussion about the effectiveness of the small business restructuring regime, but I don't recollect this being a particular issue. So I'm interested to what extent that government reviews have received information in relation to this.
Sure. I can quickly provide two broad statements,
Sure.
and I'll certainly take the rest on notice. So in terms of data and the appreciation of what an impact this is, it's quite difficult to quantify the issue because the companies are simply not accessing the regime that allows us to have the data to see.
But it came to your attention.
It came to my attention through interviews and surveys with insolvency practitioners. So I can certainly draw on my PhD research to provide that quantitative aspect. And then to what extent has this been raised previously? The 2023 inquiry was quite in the infancy of the small business restructuring regime.
Yep.
So a lot of the discussion and the submissions that were made there were very high level and about issues that perhaps were teething problems.
Yep.
My PhD looked at that and said, well, these are actually the key issues that arise as a result of that.
Were you greatly impressed by the work this committee did?
I was actually greatly impressed. Yes. And I'm not just saying that.
You're not just saying that.
I'm not just saying that. I was, to be fair, I was right about halfway through my PhD when the committee investigated the small business restructuring regime, and I was a bit worried that maybe it would just throw my research out the window. But
you're concerned that our committee work would overtake your PhD
Exactly,
thesis.
that's
You
right.
had nothing to worry about, Dr. Paul. Thank you, Chair.
Thank you.
I just want to pick up again on some comments from Senator Scarlett. I just want to be clear that I understand you said the definition of restructuring varies across state jurisdictions.
Insolvency event.
Insolvency event.
Yes.
Sorry, insolvency event. And the small business restructuring framework, does that vary by state?
No, that's
That
a
is the
corporate
corporate
pathway.
okay.
Yeah,
Just wanted
sorry,
to
a
make
Commonwealth pathway.
Yeah,
Sorry.
I just wanted to make sure I understood.
Yes. So a Commonwealth pathway in the corporations legislation,
Yep.
But industries are governed at a state and territory level,
Correct.
so that's where that insolvency event aspect comes in.
Okay, I've got it. And are there other areas in law or, regulations where you're seeing similar, I'll just call them roadblocks to continuous insurance or even access to insurance?
Anecdotally, because I don't have firm data on this, I understand there are similar issues with tax agents, with their licences being automatically cancelled upon an insolvency event, including this restructuring pathway, and similar styles of business operations. So where you are required to have a licence at a state or territory level, and that would necessitate an entire review of all of the state and territory legislation dealing with each industry, and I haven't undertaken that work yet. But it depends on how that industry regulator interprets the definition of insolvency event and whether that dictates the cancelling or otherwise of the licence.
Okay, that makes sense. Thank you. And I just want to go back to a comment, I think it might have been earlier, in relation to greater recognition of psychological injuries and that contributing to increased insurance premiums.
Yes.
Now, you covered this in your submission. Mm-hmm. We're hearing also that from certain quarters, we're getting mixed views that there are increased payouts for health or injury in workplace incidents, and therefore that's why insurance premiums are going up. Others are telling us that's not the case. Have you got any data or insights that you can share to say this is what you're seeing in the world that you're looking at in relation to psychological injuries? And if possible, are you seeing that reflected in increased payouts to people in the, to workers in the industry?
That is outside the scope of what I have looked at to date. I am hoping to embark on research that does draw from my PhD in this CRC project, which did, that analysis of the free text field we undertook with ASIC did highlight that mental health was either a driver of insolvency or a result of insolvency, no doubt both. And I want to take that one step further to really dig into, to what extent does mental health impact on this framework, or is caused by this framework for small business owners, and then that obviously drives into some of these other issues. But in terms of increases in insurance premiums and the like, I'm afraid I don't have anything.
But have you seen a spike in mental health distress within the sector?
It has been that way for some time. When you look back at the literature, mental health in the construction industry has been a really big issue.
Has it spiked, though, in the last 5 years?
No, not necessarily. It seems to be consistently high. There are now mitigating factors in place. We have mates in construction and those types of construction-specific mental health avenues that are available for those operating in the industry. They seem to be having some effect, but in terms of the data or how they are benefiting the industry, I'm afraid I don't have that knowledge.
No worries. And just another question on mitigation. You just mentioned mates in construction in relation to mental health, but generally, I mean, we're talking about a high-risk sector. If I am an individual home builder, small business, etc., if I take steps to mitigate my risk, given the size of the problem in the sector, is my one action going to reduce my premiums? Have you seen anything like that? Because it strikes me that if it's such a big industry-wide issue, and I asked Suncorp before in relation to this industry approach to insurance. Are you seeing? What are you seeing?
I don't have access to data that tells me an answer to your specific question, but certainly there are construction-specific insurance coverage. Construction is seen as inherently high risk. Unfortunately for the industry, there are systemic issues that operate within it because, as I said earlier, most in the residential construction space, most are small businesses. They are really good at doing their job. They're not really great at running a business. So long-term keeping it afloat, having business plans, knowing how to keep accurate books and records. So there are issues there. And what it would be great if there was a neat answer that said if we fix this one problem, this would reduce the risk in the industry. But unfortunately, I don't think we can fix one problem. There are so many overlapping issues. And in our report, we have a systems analysis that shows where there are several friction points in the industry. Your regulation, finance, the legal framework, the nature of the business and the characteristics themselves, that all come into play. So it's a very difficult industry to operate in and very cash flow patchy. For want of a better word. And that is largely governed by these contracts that they're required to operate under, so usually with 4 or 5 progress payments, but big gaps in between where they have to use those funds to fund the next stage of the progress or construction. And like I said, if there are other issues on other projects that they're working on, and usually they've got a couple on hand at a particular time, at each time. If there are any delays in those other projects, whether it's their fault or not, that can have really significant flow-on implications for them down the track and can, lead them to financial distress and insolvency, even if they are otherwise viable.
Yeah. And did any of your research actually look at the insolvency rates? Will you were, going on the logic of housing prices, to build now is so much more expensive. We're hearing that there are even certain builders that will only build single dwellings because of the costs and therefore because of the risk.
Yes.
at what trajectory is that insolvency going, or risk of, even just the risk of insolvency? Have you?
Yeah. So when you the ASIC, the Corporate Regulators Insolvency Statistic dataset, since 2021 has become far more granular. It allows us to really dig down into some of the subsets, which is excellent. What we see is, although there's a lot of media coverage all the time about construction industries and heightened insolvency, yes, it's a high rate of insolvency across the board. It hasn't necessarily increased since COVID. It's kind of just got back to the trajectory it was on before COVID. And those numbers keep going up. I'm not sure when they will stabilise, but it's certainly something I can look at those statistics again and provide you with some more
Thank you,
figures
that'd be
if you'd
helpful.
like.
That's it, Chair.
Perfect. That's where I want to pick up.
Yes, okay.
Thank you for your comments. In your opening comments, you spoke about these insolvencies of small businesses, thin margins, high risk.
Yes.
Did you mention that the insolvencies were increasing, or in your opening comments, or are they stabilising?
It depends which data sets you look at. But yes, look, insolvencies are increasing. In the construction industry, they are remaining about the same, but they are consistently one of the top 3 industries that enter insolvency. And that's been the case for a long time.
I asked through the prism of, you may have been in the room when we asked the previous insurer what was part of your premium increases. Why were your costs going up? And the response we got from them was the cost of reconstruction. What made up part of that componentry. And if we have less people offering competition in the market,
Yes.
in that space, is that leading to, and this is not a question for you to answer, other than what could we be doing? What could we be doing? Because I looked at your 4 recommendations in your submission. What could we be doing to help reduce the amount, because we've got a housing crisis.
We do.
We're building less houses now, over the last decade than we have ever, at a time when we need more, and arguably more people going into insolvency.
Correct.
From what your data's sharing with us. Traditionally in the housing sector, we have, and forget all the politics, and look at the way that we construct a new build. You sign up, and I'm going to tell you what, as a builder, I'm going to tell you what the price is going to be, and I'll finish it in 12 months.
Yes.
If you go into a high inflationary period, I mean, without having the complex, higher level commercial operations have variations, but I don't believe they exist in a standard dwelling
Yes.
construction.
Yes.
Is there any? And there's no evidence of variations in all cost plus contracts. Can you want to? Just
I can talk further to that.
Yeah.
So certainly in the residential construction space, builders are limited by, firstly, the nature of the contract that they enter. And they are predominantly fixed price. And the reason they're fixed price is because when a mum and dad goes to their lender and says, I want to build a house, the bank will say, well, how much is it going to cost? And they will lend on a fixed price contract because that gives them confidence in how much money they need to lend. When you enter into a variable or cost plus contract, that doesn't give them the confidence under their prudential standards that they need to operate in. And so they will refuse to lend, as we understand it from our workshop participants, to lend on cost plus contracts because they want that confidence that the build will come in at a particular price. Now, what that means for the builder, of course, is, as we saw during COVID, if they have entered into a construction contract on a fixed price basis, even if materials increase in value, they can't recover that. They have to bear that themselves. So that leads them down this insolvency pathway again. You know, they are bearing these costs that are really outside their control.
So let's tease that out and take that to the next step. The builder goes insolvent. He's taken 2 or 3 drawdown payments.
Yes.
The purchaser is now left with say, let's say 50% exposure on the cost of the dwelling, nowhere to live, too far to go back,
Yes.
not, further enough to go forward. Who steps in there? The building
Yeah,
regulator?
so the building regulator will step in those circumstances under the home warranty insurance. So that is one of those insurance policies that the builder must take out before they commence works. Now that entirely protects the consumer. It doesn't protect the builder. It is about making sure the building work is complete so the consumer can move in. It doesn't protect the builder. It's not insurance for them. And workshop participants, in fact, told us that in some jurisdictions, the insurer will pay out under the home warranty insurance scheme, but then claim back the monies they pay out from the builder themselves. We didn't dig down further into why that is the case, but that seemed extraordinary to me.
I was going to ask, did your studies with your co-authors, and I acknowledge the work that they've done as well, did you have a look as to whether or not when those builders went into the insolvency, did they stay in the industry or did they leave it? And I'm thinking, does that, with that, if there is an exodus of people leaving the sector, everyone from mum and dad up the street are saying they cannot get trades.
Yes. So again, anecdotally from our workshop data, we were told that firstly, they can't get new entrants into the market. They can't get employees to assist them. So if they want to retire from their small business, they've got no one to sell it to. They just have to shut up shop. And that can be not necessarily because they are ready to retire, but because they've got industries associated with working in the construction industry. Their knees are not as good as they were. They simply can't conduct the work, but they can't get apprentices and the like to assist them in that endeavour. And can you remind me of the question, please?
I'm just going to take it, we can't get trades.
Yes.
I saw some data the other day from the free fee TAFE.
Yes.
There was less than 8% coming out in the construction centre.
Yes.
Of all those that were starting. That wasn't the completion numbers, that was just the commencement.
That's correct. And there is one of the other systemic issues in the industry is the access to training as an apprentice. So there are independent and private enterprises that conduct the certificates or provide certificate entry training. TAFE used to be the primary body that would undertake that training, but what I understand, there was some policy change a few years ago, a while ago.
It was about when builders went insolvent, did they leave the industry?
There's no data to assist us with that because once they become insolvent, there's no way to identify when they restart again. If we, perhaps the director identification numbers could assist us with that because, if you've got a director with a number and they start a new business, that would be helpful. We know anecdotally there are issues with construction directors leaving one business and starting up another, phoenixing, as you will. We didn't look at that in this report. That could be its own research question.
Did you do any work on cost plus or restructuring contracts?
Only to
I'm
the
just thinking
extent-
because we've got your recommendations online, but I wouldn't have minded to
Yes.
have something more tangible.
Oh,
that
I can give you some more detail from our CRC report, looking at what the impact of those contracts are on the industry. We looked at them in a level of detail, but of course we had so many other issues we were considering. But I can certainly provide you with some of that detail about the cost plus contracts.
Yep. Conscious of time, just gone 12:30. Any other questions from members before we wrap up? Thank you for taking the time to give us evidence today. You've been asked to provide any answers or questions on notice or additional information. Could you forward that to the Secretariat by 15th of July, 2006?
I can.
2026, yeah. That concludes this session. The committee will suspend until 1:30. Thank you for
Thank you very much.
Thank you. Thank you. Plumbers Association of New Zealand, Australia and New Zealand. I understand that information on parliamentary privilege and the protections of witnesses that giving evidence to the Senate committee has already been provided to you. For the Hansard, you were nodding.
Yes.
For the Hansard record, would you please state your full name and the capacity in which you appear today?
Penelope Ann Corner, and I'm representing the Master Plumbers Australia and New Zealand.
Thank you, Ms Corner. I now invite you to make a short opening statement. And at the conclusion of any remarks, I invite members of the committee to ask you questions. Welcome, and over to you.
Great, thank you. Good afternoon, Chair and committee members. I've already stated who I am. I'm here representing Master Plumbers Australia and New Zealand, which is the national body representing licensed plumbing and gas contractors across Australia and New Zealand. Our members are predominantly small and family business owners operating across the residential, construction and infrastructure sectors. So insurance is not optional for our industry. It is a fundamental part of operating a licensed and regulated trade. Plumbing and gas work has direct impact on public health, safety, building integrity and consumer protection. Appropriate insurance protects not only businesses, but also homeowners, building owners, and of course the broader community. However, our members are increasingly telling us that insurance is becoming more and more expensive, more complex, and in some cases more difficult to access. So firstly, affordability is a significant issue. Many small plumbing businesses are experiencing substantial premium increases, increased excess levels and fewer insurers willing to provide specialist cover for the construction-related activities. For many small businesses already managing increased costs of labour, materials, fuel, compliance and doing business, insurance is becoming another significant pressure. Secondly, the complexity of insurance products creates challenges for small businesses. A plumbing business may be required to hold multiple insurance products, for example, public liability, professional indemnity, tools, vehicles, equipment, cyber, and of course, business interruption insurance. Policies are very lengthy, highly technical, and difficult for small businesses to interpret. Another issue we'd like to bring to the committee's attention is the increasing restriction placed on licensed plumbing businesses working on multi-storey buildings. We have received feedback that some insurers are refusing to provide coverage for plumbing businesses undertaking work on buildings above 3 stories, or are imposing significant premium increases and restrictive conditions. This is particularly concerning given the national focus on increasing housing supply and delivering more medium and high density developments. If appropriately licensed and qualified plumbing businesses cannot obtain suitable insurance, they may be excluded from participating in these projects. There is also significant complexity created around inconsistent insurance requirements across jurisdictions and territories. Different licensing requirements, minimum coverage levels and warranty arrangements create additional administrative burdens for businesses. We also believe there's an opportunity to improve consumer education. Many homeowners assume that when they engage a licensed plumber to come out, that they will be protected. However, if they undertake regulated plumbing work themselves or they engage an unlicensed operator, they may discover that insurance protections are limited or unavailable when something goes wrong. Better education from insurers and regulators would help consumers understand these risks. In closing, Master Plumbers Australia and New Zealand believes that there are several practical reforms that would improve the small business insurance market. These include improving the use of plain language in insurance policies, improving transparency and comparability of insurance products, developing practical guidance for small businesses, working towards greater consistency of insurance requirements across jurisdictions, monitoring the affordability and availability of insurance for licensed trades, and investigating the growing restrictions on insurance coverage for multi-storey construction. The plumbing industry plays a critical role in delivering safe homes, supporting public health, and achieving Australia's housing and infrastructure objectives. It is important that appropriately licensed and qualified small businesses can access affordable, practical and fit-for-purpose insurance products. Thank you again for the opportunity to present today.
Thank you very much. Senator Scarr.
Thank you, Chair, and thank you, Mrs Corner, for appearing today. And my first question is, when we're considering this in the context of plumbers and small businesses consisting of plumbers, we're having this debate, aren't we, in the context where there's a huge shortage of plumbers in the existing market. Is that correct? Can you give us some sort of indication as to the shortage we're currently facing with respect to plumbers?
Sure. So there is a shortage within the building construction industry more broadly, but specifically in the plumbing industry. So in Australia, there is about 65 to 70,000 licensed plumbers. And in terms of what they're predicting over the next 6 years, particularly here in Queensland, obviously with the Olympics coming, they're saying that just in Queensland, there's a shortage of about 1,800. So if you multiply that throughout the jurisdictions, there is a huge shortfall. And we believe that there's several reasons for the shortages. It is very expensive for an employer to put on an apprentice. And so the costs to businesses to put on an apprentice is more than $250,000 over a 4-year apprenticeship. That is a huge cost for businesses to be able to undertake. I'll give you an example. Recently, a member put up a Seek advertisement looking for an apprentice. He received 370 applications. So that demonstrates that young people want to get into the industry, which is fantastic. We just don't have enough employers that are willing to put them on at the moment because of the cost. So more funding, more incentives, more support for businesses is the key to growing that.
Okay.
Migration is a separate issue as well.
Yeah, okay. Well, that's the end of my easy questions. But I'll move on to some particular questions. This issue of the difficulty procuring insurance for multi-storey construction. Your submission was the first I'd heard of this phenomenon. When did this occur? What's the scale of it? Can you give us any more information? And feel free to take on notice this question and provide us more data so we can get a better feel for it, because I'd like to raise it with a number of the insurance providers, because it's and to explore whether or not, as the Chair says, whether or not it's the same with respect to other trades working at height.
Yeah, sure. So we were advised of this probably back in 2019, 2020, in terms of the height restrictions that they were imposing, because members had reached out to us directly to raise concerns. I don't believe it's been quite forthcoming in all the policies. It sort of tends to be, you've got to dig through and actually find it. We have been advised that we undertook some research with a broker a couple of years ago to get some stats and some data. And I looked at just sort of like a typical size business. They might have 6 employees, annual turnover about $1.4 million, maybe $150,000 in subcontractor payments, combination of domestic and commercial plumbing work, a $20 million public liability requirement, no insurance claims in the previous 5 years, and a requirement to undertake work above 3 stories. So despite this business actually being a well-established business, and they had positive claims history, quotations were sought from 30 insurance and underwriters, and only 4 were willing to provide cover without height restrictions. And the premiums offered by those 4 providers ranged significantly from $5,000 through to $15,000 per annum. So you can see that demonstrates a restriction. So our understanding, the reason why they are putting restrictions in place is because of the potential risks associated with, say, a leak in a 30-storey building.
And there was an example in Brisbane.
Yes. There was one down the Gold Coast of recent times at the Star Casino, where there was an issue with a sprinkler pump had burst and water obviously went everywhere.
And then cascades down.
Correct. And so they're limiting their exposure, I suppose, the insurance brokers, underwriters, providers, to get involved with higher floor dwellings.
And what has Master Plumbers done to try and alleviate that?
So we have, we've spoken directly to relevant state ministers, but most of the state ministers say it's a federal issue, you need to talk to the federal minister. So we have done that. And we have got some examples. Obviously, we're here today to represent as well, to raise those concerns. But we don't seem to be having any luck in terms of where to go from here.
Have you raised it with the Insurance Council of Australia? And
I believe it's been raised with the Insurance Council of Australia as well. We've also asked the Insurance Council of Australia if they could put out the communication that I spoke about before to consumers, letting them know, like, if they do touch their own, they do try and do their own plumbing work in their home, that they might not be covered as well.
Well, from my perspective, that's, these are important points, aren't they? They're all interconnected.
Yeah.
People are maybe going external to unlicensed plumbers because they're paying less.
Yes.
There's shortage of plumbers, so they're desperate to try and get someone to rectify things, or they try and do things themselves. And then it just becomes a downward spiral in terms of liability. But, Chair, we might put some questions on notice to the Insurance Council of Australia and see if we can dig down further in relation to that issue.
That would be great.
And try and provide some assistance. Now, when
You
we
want to provide us some questions that through the committee that we will ask on your behalf?
yeah,
Okay.
'cause
Great.
it
Yeah.
would be good to try and flush that out using a plumbing analogy. In terms, sorry, that's as good as the material gets, Madonna.
That was good.
In terms of accessing insurance, surely the brokers, we're told about the key role the brokers have in
Yes.
terms of explaining insurance policies, making sure their clients get the right insurance for their businesses. What's the broker ecosystem like in relation to the plumbing industry?
Yeah, so some people will go direct to insurance providers themselves,
Right.
and other people will go through brokers. I think it really depends on the existing relationships that they have. And also, like, if they're regionally, they're going to necessarily go to their regional broker as opposed to using a large multinational organisation.
Right.
So the broker's responsibility is obviously to educate them and make them aware of it. They're
Correct.
also to provide a number of different underwriters
Correct.
for their policies for them to be able to pick and
Yep.
choose. It's just how much time, because small businesses are busy, right? They're trying to do everything. And so insurance is just another thing that they need to do.
Okay. So there aren't, are there bespoke insurers who specialise in the plumbing industry or
There are a
construction-related
couple.
industries?
There are a couple
Yep.
throughout Australia. Yes.
Okay. All right. It just surprises me that there's this issue in terms of understanding what the terms are because, well, it concerns me because the broker is meant to be educating and assisting
Yep.
the small business operator who's busy doing all the things related to keeping a business afloat.
Correct.
Yeah. In terms of, do you have any data, and feel free to take this on notice, in terms of year-on-year changes in premiums? So whether or not you've got data, say, of, you gave us an example of a small business of $1.4 million turnover, 6 employees, what premiums they're looking at in terms of getting that multi-storey insurance coverage above a certain height. I'm interested to know what other records you might have in relation, or data you have in relation to what the average cost of insurance is for different sized businesses and how that might have increased over the last 5 years. Is that something which
I can deftly
sort of
obtain
data?
that for you. I don't
Yeah.
have it, but I'll take that
Yeah.
on notice.
And feel free. You've got associations with other states
Yes.
across Australia. So it'd be interesting to know if there are any
Okay.
if there are any national trends
Yeah.
in that regard,
Okay.
and to what extent this is making it difficult for, say, that small business to put on an apprentice or to do the other things we need our plumbing businesses to do in order to provide their services. My last question, and again, you might take this on notice. We had the previous witness spoke about issues around the small business restructuring scheme, and in particular, the impact on insurance contracts, contracts of insurance arising from the initiation of a small business restructure under the Corporations Act, having the impact of voiding insurance contracts. So I'm interested to know if you've got any intelligence in relation to that issue impacting your members.
No, I don't, but I'll take that one on notice as well.
All right. Thank you, Chair.
Thank you. Ken.
Thank you. Hello. Nice to meet you. Penny, the height restrictions, I just want to cover off. So what you're saying is since 2020?
I think it was like 2019. 2020. Yes.
Insurers started to reduce the coverage they were providing to your members if they were working above a certain height. Now, is that in construction? Is it in maintenance? Is it everything?
All of the above.
All of the above, okay.
So it also depends how you determine 3 stories, like if there's a carport or a garage, and then 2 stories on top of that, is that class 3 story?
Yep.
So there's a little bit of grey area in that. But we are advised that it's been brought in because multi-story construction can improve higher value assets and potentially larger claims. And so that's why insurance providers brought it in, because of risk of flooding, buildings flooding, and therefore it costing them or impacting insurance brokers or insurance companies at a higher value. That's the feedback that we received when we questioned it.
And would that can't just be public liability they're talking about, right?
No.
It's PI as well?
Correct.
But it wouldn't be some of the others like cyber.
No.
I can't imagine that a height of a building would impact. No. So it is mainly those 2, professional indemnity liability. Okay. And on the increases in premium, do you have an indication? So plumbing's a very diverse occupation, and so there are a number of different specialties.
Yes.
Can you give us an indication of the various specialties? I guess that's the first question, then I'll follow up. Yeah.
So the specialties it could include, so obviously maintenance plumbing, so going to a consumer's property to fix a burst pipe, to fix a blocked drain, to replace a hot water system, for example.
Yep.
It could also be on a high-rise building, hospitals, so building construction. It could also be the maintenance associated with hospitals and infrastructure projects. It could be out in regional Australia where they're doing roofing work. It could be testing and maintaining hydrants and hose reels. It could be drainage work. It's quite diverse, I suppose, the area that we're referencing.
And gas? Gas
and
fitting?
gas, of course, yes.
Is that considered, you need an extra certificate for that, right?
Depending on which jurisdiction you're in,
right,
because there's different licensing requirements in each jurisdiction.
Yep.
But most people would do a plumbing apprenticeship,
yep,
and that includes their Certificate 3 gas units of competency that they would be required. So gas is also another area which could be considered high risk too.
Yeah, and that's why I'm asking the question, because if you've got all these different specialties,
yes,
the fact that they're all bundled together, like if I'm a plumber and I do maintenance which includes gas fitting,
yes,
the fact that because I'm doing gas fitting in addition to general plumbing, would that increase my premium because of the is it we're bundling one higher risk and one slightly lower risk together? I mean, that's how the insurance works, right?
Yeah. I might take that on notice just to clarify and be able to, I don't want to say yes or no either way. I'd rather have the data to pick it up.
Yeah, thank you, because we were talking earlier with Suncorp and even some of the previous hearings where there's been some discussion around industry-based insurance premiums, and they all work off their workforce standards, so to speak, and that's a key element of how they develop the premiums that are charged to small businesses. And I'm just really trying to unpack that a little bit to understand, is there something in there that creates actually this ability for prices to go up a lot higher than they would otherwise? And you also talked about restrictive conditions being put on some insurance premiums. Do you know what those? I know height obviously is going to be one of them.
Yeah, that was the main one, just the requirement to not be able to undertake work above 3 stories.
Okay. So if just say your members weren't doing that, who would do that work?
That's the problem.
Because you can't do it. To have insurance, you have to be licensed.
So effectively, you don't have to have insurance. If I was a plumbing business owner and I went to your house to do plumbing work, I actually don't need to have any insurance. But if something goes wrong, so I don't have to provide that insurance certificate to the regulator. It's different in the electrical space. There is a requirement. But you would expect, if you engage me to come out to your home and fix something, that I would have the appropriate insurance in place, right? So if something went wrong, I'm a licensed person, that it would be covered under the insurance.
Are there other trades where you don't need to have a licence that you're aware of?
Not that you don't need a license, that you don't necessarily need insurance. Like, it's not a mandatory
requirement. Okay. But it is for electricians and it is for
I understand it is
construction
for
workers.
But it's not specifically called out for plumbing.
Okay.
But as I see it, it's essential. Insurance is essential because it's not optional for our trades. If something goes wrong, the cost of that to small business, it just would not be sustainable.
Correct.
So they need it.
Yeah. And do you think consumers know where to go to check whether or not the plumber that they're engaging in whether that be within their small business or it might even be just their home? Is there a website that you can go to and you can check what?
So each regulator has the ability to list, so you can do a license search. So for example, here in Queensland, we have the Queensland Building Construction Commission.
Yep.
You can search up their website to see.
If they're insured?
No, if they are licensed.
Licensed? Yeah,
yes.
But not whether or not they're insured.
Correct.
Okay. Do you know what percentage of your membership would be insured versus uninsured?
I'd say the majority of people would hold insurance.
Majority?
Yeah, definitely.
Okay. Just want to change track just for one quick question. You talked about in your recommendations how we need to develop more nationally consistent insurance requirements. What does that mean?
Just because it varies between jurisdictions. So just having a sort of a consistent policy or consistent language in place, I think would be key.
What about standards that they would base those the industry, I guess, pool assessments around? Are they consistent across the country?
Probably not as much as we would like. And I think it's because of climate in different locations, for example. Victoria, it's cold, and it's Queensland, it's hotter. So I think that there isn't always that standardisation across the board.
So where it needs to standardise is language, product type?
Correct.
Okay, all right. And one last one. We talk about the use of brokers. Do you know what percentage of your members use brokers versus not? And do you have an indication of the insurance, the average insurance premium between the two groups?
No, but I can take that on notice.
Thank you very much. Thanks, Chair.
Thank you very, very much. Mr Moncrief.
Thank you, Chair. You talked in your, I believe it was your opening statements around the guidance for small businesses around insurance. What sort of guidance do you think would be most useful, and what sort of format do you think that would take?
Yeah, I think something that can be communicated on some particular website, or information that's available that they can share, that they can look at, something in dot point, that clearly outlines information that's going to assist them. Something that maybe is independent to a specific broker or insurance provider, so that they can look at it and go, what should I be checking? What should I have in place? What are the risks associated with it? I'll give you an example, like a plumbing business working on a hospital, doing the plumbing component of a hospital 20 years ago. The cost of that was $4 million. Go forward now, 20 years, the cost to do that work is more like $70 million. So the risk that business is facing is massive, right? 4 million, 70 million. This is what these are another reason why the insurance premiums are going up, because the cost of the projects are obviously a lot bigger than they were 20 years ago as well. But yeah, just having information available would be key, that they could go to, that they could look at, that was available on social media, just easy dot point information.
So that would be information around pricing in the industry?
Pricing, policies, what they needed to be aware of. Just anything that's going to help them or support them before they sign up for their next renewal, right?
Okay. Do you think, is that something that people, that plumbers themselves are going to be the ones that are for finding out what's a fit? I would imagine that sort of in most industries, you sort of people on the ground who are doing it on a day-to-day basis, they're the ones that are noticing what's a good price and what's not. Is that
correct? And so we often see in small businesses that a lot of the time, without stereotyping, that the husband is the plumber and is out on the tools, and the wife a lot of the times, or it's sometimes the mother, the sister, there's some sort of family connection is supporting in the business. They're the ones that scrutinising the bills, whether that's from their local plumbing supply store or whether it's their insurance premiums that are coming through. They're looking at it and deciding, why has it gone up from this to this? What are our other options out there? Should we be consulting with another insurance provider or broker? How do we get the best price? How do we make sure that we're still covered appropriately? So I think a lot of the times you're talking to the person that's running the business, which is sometimes obviously the plumber himself or herself, but also then you've got that support within the business.
Yeah, okay, cool.
So getting the message out to that person would be key.
Yeah, okay. On a somewhat related note, you said in response to Senator Scarr's questions around the specialised insurers, you said there were a couple in the market. Are there barriers that are preventing those specialised insurers becoming more broadly accessible to the market?
I'm not sure, to be honest.
Okay.
Yeah.
Sure. Okay. Is that something that would it be of help to your members if those specialised insurers were more accessible?
Yes, definitely.
Yeah. Okay. You don't have a view about what is stopping them from being accessible at the moment.
Yeah, I suppose it's the underwriter or the insurance company, depending on how much risk they're willing to take, and if they want to get involved with businesses that are working in more than 3-story facilities.
Okay, cool. Cool. All right. You also, in your submission, talked about the establishment of monitoring of availability and affordability of small business insurance. Is that something that what format do you see that taking? Is that something that you would like the ACCC to be publishing, or what would that look like in your?
Yeah, I mean, that could be a good vehicle in order for people to be able to go and have a look and see what's comparable out there in the industry, to know whether they're getting the best deal or the best pricing available, or whether there's other options out there. Like, who's actually monitoring it? Who's checking it? No one. So having a body to have oversight over that, I think, is key. Whether that sits with the ACCC or someone else.
Okay, great. All right. Thank you, Jen.
Can I just ask one other question?
Yeah, of course.
Do you actually see claim numbers increasing amongst your members?
I'm not sure. I need to take that one on notice. We do see, obviously, claim increases with flexi hoses, which you would have all seen.
Yep. Explain that to the committee, the flexi hose.
Yeah, sure. So the flexi hose is something that sits obviously underneath your kitchen sink, for example. And we are seeing an increase in those bursting, and a lot of the times it happens while people are on holidays, away, and then obviously water floods their homes. And so we are seeing an increase in those claims that are being put in. I know there was an article in the Courier Mail just recently on that here in Queensland. So yeah, we're definitely seeing an increase in claims for that particular, but I'm not sure for specifically for plumbing businesses if there is an increase in claims. But it would definitely be something, maybe one of those questions that we could ask the Insurance Council of Australia to see if they could help give us some data on that.
Thank you.
Yeah, there was an article the other day on ABC.
Yeah.
Yes.
They had a life expectancy of around 10 years, and the plumbing guy was suggesting preventative maintenance and just having them changed.
Correct. Yeah. To ensure that somebody's checking them, making sure that there's no damage, or just replacing them.
Any further questions? Roger. Earlier on this morning, we heard from an insurance company that gave evidence to the committee stating that their premiums, and that's what we're investigating ultimately, is the increase in premiums, that premiums were rising as a result of the increasing cost of rebuilds, and after weather events. Do you know what the going rate for a tradesman or a plumber is at the moment?
It would depend on
Give me some scope.
business situation. We don't sort of specify a specific hourly rate, just because each business is different depending on their location, their size.
Would that rate have increased over the years, say in the last decade?
Yes, of course.
Yeah.
Yeah.
What would have been the pressures that increased that rate?
What would have been
What would have been the issues or the factors that would have increased the hourly rate over the
wages, products, materials, fuel?
inflation?
Correct.
Yep. Just standard increases.
Correct.
We heard evidence from a lady from UQT that had done a bit of work into insolvencies. Have you got a line of sight to any insolvency rates within the master plumber sector at the moment?
No, I don't have that data. No, but I don't know if we specifically can get it for plumbing, but I think broader for construction we could look to obtain.
Yeah, okay. I think the construction numbers are there. I just wanted to get a sense of whether or not, who was going, if builders or head contractors were going into administration, were your members getting paid? Were they becoming unintended consequences of increased insolvencies? Were they getting caught with
And some
unexpected losses?
Some of them definitely, yes. When the head contractor has gone insolvent, yes.
Yep. Okay. Well, you have clearly taken a heap of notes on notice, and rather than me add to them,
Yes.
I think I might firstly offer any final questions to committee members. Any further closing comment from you before I wind off? You've got a lot of homework there.
I do. Thank you.
Well, thank you for taking time to give evidence today. You've been asked to provide a fair bit of information there. Do you have the Secretariat's details?
Yes, I do.
They will require that information on notice to be supplied back to them no later than the 15th, Wednesday
15th of June.
of July.
Of July.
Yeah. So we thank you for your time and the evidence that you've given us and the time, and we look forward to hearing closing the loop with some feedback on you getting back to us.
Will do. Thank you very much.
Thank you.
Thank you.
Now, if we can just suspend broadcasting for a few minutes. For the sake of expediency, the committee now will proceed with the Queensland Law Society, and I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate estimates have been provided to each of you? Yeah? Yep. For the Hansard record, could each of you please state your full names and the capacity in which you appear today? And I'll start with you, Mr Murphy.
Thank you, Mr Chair. My name is Luke Murphy. I appear as, in my role as Deputy Chair of the Queensland Law Society's Accident Compensation and Tort Law Committee.
Excellent.
My name is Sarah Jane MacDonald and I appear in the capacity as the Deputy President of the Queensland Law Society.
Thank you very much.
And my name is Paul Holmes and I appear in the capacity as a member of the Competition and Consumer Law Committee of the Queensland Law Society.
Excellent. Now, I invite you each or collectively to make a short opening statement. At the conclusion that, I will throw over to Senator Paul Scarr, our Queensland resident senator, who will commence line of questioning.
Thank you.
Does anyone like opening comment?
Thank you.
Thank you.
Thank you for inviting the Queensland Law Society to appear today. As I've mentioned, my name is Sarah Jane MacDonald. I'm the Deputy President of the Society. In opening, I would like to respectfully recognise the traditional owners and custodians of the land on which we meet here in Brisbane, Meanjin, the Turrbal and Yagara peoples. As the committee may be aware, the Queensland Law Society is the peak professional body for the state's legal practitioners. We're an independent, apolitical body representing the solicitors branch of the Queensland profession. QLS appreciates the importance of this inquiry into small businesses across Australia and in particular across Queensland. Many of our members' practices are small businesses and many of our members act for small businesses. Our submission highlights the difficulties faced by small businesses in obtaining and affording adequate insurance, particularly in regions of Queensland that are subjected to natural disasters such as flooding. We are aware that there are no easy answers to these difficulties. Rather, there are a range of levers to be pulled in terms of mitigating risk and initiatives such as reinsurance pools. In terms of liability insurance, our submission extensively addresses that there is no need for significant reform of the civil liability settings in Queensland. Queensland enjoys a stable environment across the motor accident, workers' compensation and public liability spheres. QLS submits that there are a number of aspects of the Queensland schemes, particularly our pre-litigation procedures, that can be a model to other jurisdictions. I'm joined today by Luke Murphy, Deputy Chair of the QLS Accident Compensation and Tort Law Committee, and by Paul Holmes, Member of the QLS Competition and Consumer Law Committee. We welcome any questions that the committee may have.
Thank you very much. Senator.
Thank you, Chair, and thank you to the representatives of QLS for attending today, and thank you for your submission. And thanks to QLS generally, in my experience as previous capacity as member of the Legal and Constitutional Affairs Committee of the Senate, the QLS has a very good track record of making submissions to Senate to inquiries such as this, and it's really important that it does so. So. Your submission was one of the first I turned my eyes to, but maybe that's because I'm a Queensland lawyer and a past member of the QLS. I just want to quote from page 3 of your submission. We anticipate the Parliamentary Joint Committee may receive submissions regarding the civil liability settings in Australian jurisdictions and how the extent of liability and availability of damages influences the quantum of judgments or settlements and therefore insurance costs, end quote. Well, your anticipation was well-founded, and the committee has received submissions in that regard. So Mr Murphy, if I can just ask you, perhaps in the first instance, do you want to give a general response to the claims we've received from the insurance industry, etc., with respect to the impact of civil liability settings upon insurance premiums?
Certainly, Senator, and thank you for the opportunity. That paragraph that you just quoted was deliberately directed to the Insurance Council of Australia's paper, which set out, which predates the establishment of this committee of inquiry. But that paper went into some specific detail around recommendations that the Insurance Council requested consideration be given to. In the context of the Queensland jurisdiction, as our Deputy President just touched on, Our work cover regime is the most financially stable work cover regime in the country. Our CTP regime is one of the, if not the most financially stable and sustainable CTP regime in the country. They have had pre-court procedural processes in place since 1994. It started in the motor accident jurisdiction and then in work cover in 1996. What we believe within the Queensland jurisdiction is that a number of the procedural structures that have been in place for some time have underpinned that stability. I should add, also been enhanced by very, very good management of both schemes for a considerable period of time. The financial management, in contrast to the Victorian and the New South Wales work cover regimes, it's poles apart. So, coupled with the very competent and economic administration, the fundamental frameworks that have operated within the Queensland jurisdictions across all three main areas of practice have assisted enormously in maintaining a viable and a sustainable system of compensation for claimants. Now, there have been prices that have been paid by claimants in each of those structures. For example, claims that were described as less significant claims within the CTP regime have been limited in the amount of general damages that have been recovered by the application of what's called the injury scale value. There's a whole process around that. But what that did was it sought to limit the amount of damages that could be recovered for claims that are described as less significant. And then in addition to that, there has also been, for a long time now, a very strict cost regime and recovery that have limited, for example, the recovery of any costs from by a claimant who is successful. All costs have to be come out of the damages that are recovered. And then there's a second tier to that costs recovery as well. And in addition to that, Queensland has had for a long time what is unfortunately referred to as the 50-50 rule in terms of the maximum costs that can be recovered. And all of those factors... Sorry,
just explain.
Certainly, the 50-50 rule, it was first embodied in the Queensland Law Society rules and then enshrined in the Legal Profession Act in, well, the Act's 2007. I think it was enacted in the earlier piece of legislation. But that rule mandates that the costs that can be charged by a plaintiff firm, including GST, can never exceed what the claimant receives themselves. Now, that doesn't mean that all damages can be taken in costs. What happens if you settled a claim for $100,000 and there's a refund to Medicare, a refund to Centrelink, say that's $20,000, that leaves $80,000. The most that a solicitor can charge, including GST, is $40,000, and the claimant would receive $40,000. And the solicitor has to write off any additional fees that they have incurred. Now, that's worked. It has had a significant impact on the commercial viability of claims, not always advantageous to the claimant, I should add, but it has maintained a sustainable system. It's not in any other jurisdiction in Australia, to my knowledge.
Okay. So, Ms McDonald, is it fair to say when this committee has a national focus, but in terms of looking at issues like civil liability settings, yes, in legislation in particular, we need to be mindful that each state has its own regime?
That's so. Every state is different, and our submission talks about, in some respects, how the Queensland system has both statute and common law that applies in relation to some of the elements of the civil liability schemes that apply here, which is different, as I understand it, to some of the southern counterparts in how, because they do have some caps or changes in some way compared to what's here in Queensland. But certainly it is the case that it's state-based for a lot of those regimes, and so that, in my respectful submission, should be taken into account.
Okay, thank you. And Mr Holmes, when we're talking about civil liability settings, it's not a theoretical issue for someone who's suffered harm and injury, potentially unable to continue to work in their occupation, have to pay medical expenses, family members maybe have to take time off work to care for them. These are real impacts, aren't they?
Absolutely, Senator, and they're things that ordinary people deal with on a daily basis, and the balance found that Mr Murphy referred to, I think, has shown its benefits in Queensland.
Yeah. Mr Murphy, you referred to a paper that was put out by the Insurance Council of Australia. Just for the record, was that paper the Sustainable Public Liability Insurance Market in Australia, the case for civil liability reform?
Yeah, dated October, Senator?
October 2025?
That's right. Yes, yeah. That was that paper.
So, if Chair, if you're happy for me to do this, I just wanted to put to the witnesses a number of the recommendations in this this paper, and perhaps if you could just provide your response, and feel free to refer to sections of your submission, and also feel free to take anything on notice where you want to provide a more detailed response. So this issue of the impact of psychological claims of insurance is raised in this paper, and it says, I quote from the recommendations, policymakers should consider the following reforms. In a common law claim where there is both a physical injury and a mental psychological injury, damages should be assessed as the greater of the physical or mental psychological injury, but not combined.
Senator, and you will have seen in our submission on page, if I can take you to page 5, under the heading Damages, Psychological Injuries, the second paragraph, we refer to, I mentioned earlier, the ISV, the injury scale value. There is already in Queensland, within the civil liability regulations, provision that is to that effect. Now, it needs to be very clear here that that only references general damages.
Okay.
That's not a reference to any of the other economic loss claims or care claims or things of that nature.
Yeah.
So there is scope for that. I might just leave it at that.
Okay. They say, allow consideration of a mental psychological injury component of a claim only where treatment was sought and obtained by the claimant within 12 months of the initial physical injury.
Certainly not in the view of the Law Society, and that's for a very specific reason. And Mr Holmes touched on it earlier, is that a significant number of the members of the public simply cannot afford to seek treatment. Within the public liability sphere, if you sustain an injury, there is no rehabilitation provided like there is in the work cover and the motor vehicle regime. Those insurers are obligated to provide rehabilitation. In the public liability scheme, you are left in the Medicare system. Now, there are a number of examples currently in the Queensland CTP and work cover regimes where rehabilitation has to be provided, where clients have not been able to secure any attendance on a psychiatrist for over 12 months. I have 2 clients who were suicidal. A young 21-year-old who sustained a serious spinal injury 18 months after the accident, had still not been able to be seen by a psychiatrist. So to impose a threshold of that nature just cannot be supported, in our view, in any way, shape or form.
So your client, Mr Murphy, that you're referring to, wasn't able to secure the services of a psychiatrist because of wait times, etc. Is that correct?
The psychiatrist would not take. No psychiatrist had an open book.
Which goes to, and Ms McDonald, I might just make this comment and let you respond, which goes to the issue around access to mental health services generally in our society, doesn't it?
It does, Senator, and if I can add to that, it's probably more difficult in regional and remote communities where in some areas there's significant travel that's required in order to even get to the offices of a psychiatrist or some other expert in that nature. So there are delays not just by virtue of there not being available books, but also not being available books in that area, all the costs associated ancillary to the appointment costs.
Yeah.
Sorry, could I just add one thing?
Sure, please.
I referred earlier to a submission we have just made to a review of the work current. In that submission, jointly with the senior psychiatrists from the Medical Assessment Tribunal, this very point was acknowledged and raised. So it is something that the Psychiatry College is very conscious of, and all of the relevant government regulators.
Sorry? Yeah. Was this, so the Chair's just raised a question, was it, in terms of your client who'd suffered this serious spinal injury, and I can only imagine what they're going through, would they try and access a psychiatrist in a regional area or a city area or metropolitan area?
Interestingly, at the time of the accident, my client was Brisbane-based, and it was accessing psychiatry assistance in Brisbane. She has subsequently moved to a regional area, and is the only availability for her now is telehealth attendances with a psychologist, but there are difficulties in that respect as well.
Okay, well, we need to do better as a society in terms of providing access to those services. So my thoughts, and I'm sure all committee members' thoughts, are with her. Can I just two quick questions to round off my questions? And it's you nearly have this. You have an inquiry like this. You're nearly engaging in warfare by anecdote. So anecdotes will be put up to just look, the system's not working because of this anecdote, right? So I think it is sobering to actually look at what happens in the case law. And you refer to in your submission this case of Lundebergs and Vu and another. I'm wondering if you can just give us a précis of the of that case and how it shows that perhaps the system is working from a common law perspective in terms of addressing these issues, and the common law develops over time.
It does, Senator. The Lundberg case involved interestingly, a plaintiff personal injury practitioner who was bringing the claim. The claimant was the claimant's husband and 3 children, I think, were involved in a relatively minor motor vehicle accident. There was no significant injuries. Emergency services did attend. Following the accident, and there were no significant long-term consequences from injuries. Following the accident, the mother and wife of those involved in the accident decompensated, stopped work, and brought a personal injury claim under the Motor Accident Insurance Act.
So just to be clear for the record, the claimant in this case wasn't actually involved in the accident.
Nor there.
Was not at the accident, but the fact the accident had occurred was communicated to the complainant, whose loved ones were in the accident, and that claimant brought the action in terms of the psychological impact.
That's right. Yep. And The claim was dismissed by the Supreme Court on the basis that it simply could not have been foreseen that a accident of this nature could result in injuries of the nature that were claimed.
Yeah.
And from the society's point of view, we view that as being a significant example of how the common law works successfully to influence the conduct of claims, and it has certainly had a significant influence in the response that has been received from a number of the insurers within the CTP regime.
Yeah. So, in short, would you agree, Ms McDonald, that at least from a Queensland context, and that's what you're speaking to, perhaps even more generally, great care needs to be taken before there's any fiddling with or adjustment to the current civil liability legal settings, because they could have, any such adjustments could have profoundly negative impacts upon everyday Queenslanders, Australians who are seeking compensation when they suffer loss.
That's so, Senator. Our position is that Queensland is effectively working quite well in the circumstances. There is always tension between all of the interplay parties in these circumstances. It's our position that Queensland does that quite well, and that there should be very careful consideration given before any amendments that would change that current status quo.
And indeed, other state and territory jurisdictions might look to Queensland for examples as to how different complicated matters have been dealt with.
That's so. That's our submission, is that Queensland does it well. We've done it well for a long time. Mr Murphy has spoken that we've had things like pre-action procedures in place since 1994 and 1996, and we say that they perhaps should be adopted by our southern counterparts.
Excellent. Thank you. Thanks.
Senator, could I just add one thing to that? The paper that the Insurance Council that you referenced, in their recommendations, a number of those recommendations are the adoption, not all of them, but the adoption of a number of the Queensland initiatives.
Yeah. Very good. Thank you.
Mr Moncrieff.
Thank you, Chair. In your submission, you said that to address rising insurance costs, you think there should be a focus on risk mitigation and claims management. I just wonder if you could give the committee an idea of what sort of risk mitigation you'd see in the relevant industries that we're talking about here.
Absolutely, Senator. Beg your pardon, Member. So the sorts of things we're talking about, the ACCC did a Northern Insurance inquiry, I believe it's about 4 or 5 years ago, and a lot of their recommendations, although focused on residential areas, I think have a parallel application to small business. So what you're looking for are things like many Queensland towns are now starting to have levies built around them. There was a time where, and I believe Suncorp might have appeared earlier in the day, where they refused to insure any or take any new policies for business or residential areas in Roma until the levy was built around it. So that's one example. The other example I would refer to looks to things like mitigation measures done on individual properties, so individual businesses, because as it stands at the moment, when businesses get insurance renewals, there's no indication to them of what they could do to that individual property to reduce their insurance costs. That's just not something that they're told about. And so what we would say is that if you gave businesses a clue that, for example, if you put one of your buildings up higher so that any flood would pass underneath it, your insurance premium might go down by 10, 15. I don't know the figures because I'm not privy to the insurer's methods for working them out. But if you make that sort of information public, businesses will make a business decision and say, yeah, actually it's worth it because I might have to pay 5 or 10 grand now to raise it, but over the next 3 or 4 years that'll save me 30 or 40 grand in cost.
So do you think it's the role of the individual insurers to be putting that information out there about how they're pricing these products?
Yes, and that's something that has been advocated by certainly consumer advocates and consumer organisations both in the business and in the residential space.
And is that sort of information, is that something that you think that they should be publishing on an individual to customer basis,
Yes.
or do you think they should be publishing broad guidance in advance, or both? Or
I think it's probably a combination of both, because I think you can give some broad guidance about the sorts of things that might help or help risk or manage risk. But I think to get the full benefit of doing something like that, you need to give that specific information on a business level, because the reality is that properties next door to each other have different topography.
Sure.
And what works on one property might not necessarily work to mitigate the risk on the one next to it.
so do you think it's the case that when customers are seeking to buy insurance for the first time, that assessments should be made by the insurers at that point?
I'm not sure it's around that. I think it's both at the first point and at each renewal.
Okay, yeah.
Because the reality is what goes on properties or how they're impacted in that 12 months might actually affect that answer. And if anybody's in the right position to be able to give that detail, it's a combination of the insurer and the government data they have around weather and the effect that's had on various properties in various regions.
Do you think insurers have the appropriate incentives in place to ask those questions and give that advice at the moment? Like, are there barriers that are stopping them from doing that at the moment?
I'm not sure of internal barriers to the insurers, but what I would say about that is the data's there, and our submission would be there's no reason why you can't provide at least some clues.
The data's there, as in the insurance.
The insurers, as I understand it, would have data about the effect that various disasters over the years have had on individual properties and individual business units.
They're just not sharing them with the people they're insuring.
Well, there's no requirement that goes on any renewals at the moment. So what I would say is, if say a business has been affected by 2 floods and it's gone through a property at 2 metres, one of the obvious things that if I'm an insurer I would hope I'd want to do is say to that business owner, if you manage to get your PowerPoints up at 3 metres, that's going to reduce your risk of having a major impact when this flood comes through again, and that's going to reduce your insurance premium by however much that is. Obviously, there are other government fees involved in insurance premium, which you can't affect by managing risk. But consumers and businesses should be given that opportunity to at least make a decision to try and reduce those costs.
Okay. We've heard from some of other submitters around the increase in litigation in Australia, and we've heard that some people find that's a factor in rising premiums. Does the society have a view on whether that is an impact on rising premiums?
Member, I might take that question. Would it be a potential contributing factor? Certainly, along with many others. To suggest, as has been made, or to make a suggestion of the nature that I think the expression was Australia is now the most litigious society. I don't think that there is any hard basis for that, with one exception possibly, and that is the potential in relation to the class action area. And that's been something that has been acknowledged by the government since the Morrison government, when the then Prime Minister and Treasurer endeavoured to implement changes to limit the influence of, particularly of litigation funders in that sphere. So if in fact the class action sphere was to be removed, to suggest that Australia is a more litigious society than the United States, I think just cannot be substantiated for a number of reasons. Within the public liability sphere, the Americans are entitled to a trial by jury. That's not an entitlement that exists within Australia, with a couple of exceptions which I won't go into, but the vast majority, well over 90% of public liability claims, you are not entitled to a jury trial. That's significant for the second reason. There is no real capacity in Australia to award exemplary damages, and that is where, in the United States, you have these exorbitant damages judgments being awarded by a jury. Hundreds and hundreds of millions of dollars to punish the defendant. There's anecdotal stories that I'm sure you're all familiar with, I won't go into them, that highlight those. And understandably, when the exemplary damages are there for that purpose, that doesn't exist in Australia. Within the Queensland jurisdiction, the less than 2% of personal injury claims actually go to trial. Vast majority are settled. A significant proportion of those without the institution of legal proceedings because of the pre-court processes that have been in place and that I've referred to earlier. I believe, and it varies from the motor accident to the work cover to the public liability jurisdictions, that it's certainly in the order of 50% that would be resolved without the institution of legal proceedings. It could be higher, and with apologies to the Law Society staff creating more work for them, we're happy to take that on notice and provide whatever information we can on that.
They're eager, I can see it on their
Yeah. I think I'll be walking back to the office, Senator. But there has been the idea that Australia is more litigious is not something that we would accept. And
More litigious than it used to be, or more litigious than other places?
well, the expression was the most litigious society in the world.
Yeah, sure.
Yep.
But have you seen? Would you agree that it is more litigious than it used to be?
I think there's, well, depending upon what you're benchmarking. If we're benchmarking the 1980s and the early 1990s, most likely yes. And you will have seen a significant increase in advertising and things of that nature, which I'm happy to say the Law Society has opposed ever since it was first raised, and that's still the Law Society's view, but it's beyond our control. So there are more claims, but that has to be looked at proportionately, I think, in terms of population growth as well. And significantly in that respect, member, and I won't be able to give you figures, I'm sorry, but I can say this confidently, that in 2013, under the Newman government, the Queensland government brought in significant changes for a worker to be able to bring a common law claim. That was repealed with the election of the Palaszczuk government. It took well over a decade for the common law claims to even get back anywhere near what was evident at the time that the Newman government made their amendments. So in terms of litigation within that sphere, it's certainly not increased significantly. And we are only just getting the number of claims is around that same level. Statistically, these are broad figures, there's about 100,000 statutory work cover claims. Around about 3,500 to 4,000 of those claims become common law claims each year. And they, after the Newman amendments, it sat down around 3,000, and it is only in probably the last 12 to 24 months that it has started to get back to. I mean, it's been a gradual rise. And the CTP claims, and there's an actuarial report every year presented by the Motor Accident Insurance Commission. And at the most recent actuarial report in March, the value of claims per claim had increased, but that had been as a result of the number of claims decreasing. And the statistical analysis of that from the actuaries is that what has been removed from the claim numbers are the less significant claims. So when you remove the less significant claims, the value per claim obviously increases.
Right. Okay. All right. Thank you, Chair.
Thank you very much. Ms Jarrett.
Thank you. I've got a few questions there, so bear with me as we jump all over the place here. I just wanted to go back to the processes that we have in Queensland, and you said our civil liability settings are quite good compared to elsewhere. And we've had others talk to us about the insurance frameworks needing to be more consistent. So if we had a more consistent insurance framework and a more consistent legal framework, I understand that obviously people bring actions in different states, but if there was, say, two priorities that we do really well in Queensland that aren't happening in other states, what would we think about telling those other states or advising those other states or suggesting they look into?
Can I apologise to the committee that I appear to be dominating the responses? The two that I would highlight, Member, are firstly, and this puts the fear of God into a number of our colleagues interstate. I should put that on the record now.
Okay.
In Queensland, there is, in the pre-court process, complete disclosure.
Right.
So any medical report that is obtained, any witness, well, I'll backtrack from the witness statements. Any medical reports that are obtained, any expert reports that are obtained, have to be disclosed within a month of receipt. And that's from both plaintiff and defendant. And at the time that you disclose them, you also have to disclose the letter of instruction to that expert. Now, I can say, comparing that to New South Wales, for example, New South Wales actually enter into negotiations where they don't know what the other party's medical report says. It's a cultural change.
Did that used to happen in Queensland though prior to, you said 96?
1994, they brought in in the Motor Accident Insurance Commission was the first, sorry, I beg your pardon, the Motor Accident Insurance Act. They brought in the pre-court process of disclosure. There was prior to that a process under the Supreme Court rules where they had brought in again, so prior to 1994 there was no pre-court process. You used to institute proceedings straight away. There was a process brought in, of course, which produced a document called the Statement of Loss and Damage, and in that all reports had to be disclosed. So it's been in Queensland for a significant period of time.
And have you got data that shows how that's affected costs of litigation?
No, probably not.
What a shame.
The best example, I mean, the best answer to that, member, would be the costs that are saved by the resolutions through the pre-court process. I can say to you that from 1994 to about 2010, again, I'm dropping into anecdotal stories, I apologise, but the firm of which I have been a member, we used to resolve somewhere between 90 to 95% of our motor accident claims at the compulsory conference. Now that has decreased significantly for a whole series of reasons, but when you have that level of resolution, the cost savings are enormous.
Yeah, I get that.
And it's actually, and this is not...
Used to meaning past tense?
Used to resolve, yeah. And this is just from a firm's point of view, Chair, we don't have that same rate of resolution. We still resolve a number of them, but not at that rate. I won't bore you. I have a personal view about what contributes to that, but you'd be here until midnight.
I'm sure Mrs Jarrett will tease that out of you if she wishes.
I'm more interested actually in frictional costs that are caught up in the processes, because we have had somebody talk to us about or give evidence about the fact that there are too many frictional costs in the legal process. Now, that may not necessarily be in Australia, in Queensland, it could be in other parts of Australia. Are you seeing, like in your world, are you seeing anything, are you hearing from your colleagues in other states that this is an issue?
Can I just make sure I understand what's meant by frictional costs?
Yeah, all the additional small fees paid here, or I guess, what they were predominantly talking about was, I've got a fee here and I've got a fee there. I need to do this before I do this, and everything has a cost to it. It's not insurance costs. It's the costs of all the legal components. So submitting a document here, having to pay for this before I hit the submit button.
If it's a reference, member, to the costs of obtaining the necessary evidence and the costs of instituting...
It's partially that, yeah.
Yeah, well, I mean, if a claim's going to be properly put together, and the whole justification for the claim process, taking it back to the very basics, is to return the person who was injured to the position they were in before they were injured. So to do that properly, you have to firstly understand what position they were in, firstly, and then you have to understand the injuries and the nature of their loss. And that requires the necessity of firstly getting proper rehabilitation to go through that process, then getting an appropriately qualified medical expert, usually, in 99% of occasions, to provide a prognosis for the future based on that evidence. But you've got to collect that evidence to get a proper prognosis. So there is costs associated with collecting that evidence, and that's what the people that practice in my area of practice are expert in.
Yeah. Remember, if I could add there too, in terms of cost of those reports, I'm aware the public trustee funds legal aid Queensland to operate what's called the Civil Law Legal Aid Scheme, where the person may not have been able to afford the cost of those expert reports, and they are on a lower income. They can, through their firm speccing it, can apply to have those costs paid for them prospectively, and then once the claim's successful, that scheme gets reimbursed, and that allows a lot of claims to proceed that would not otherwise have been able to proceed because of costs you're referring to.
And additionally, a lot of the costs that you might be talking about, like filing fees or those other report fees, in a lot of senses, for a lot of firms, they might be conducting this in a way in which means that the firm is paying that cost, not the claimant. So it's the case that, yes, there are a lot of fees. Everything, I think, is expensive that everybody wants to do out in the world all the time. But those costs perhaps are not being upfront paid by claimants. They are often being borne by law firms in regional Queensland or across Queensland who are paying upfront the filing fee, the mediator's fees, the expert medical report fees, and carrying that responsibility until a time when the matter does resolve, in which case they get reimbursed and are subject to that 50-50 rule that Mr Murphy was talking about.
I understand. So that's a slightly different perspective than what they were sharing with us, which is good to hear.
Sorry, can I just add one further thing? There are certainly examples, and our Deputy President just touched on some of the specific examples, but there will be examples of claims on both sides of the practice area where people have been forced through the procedures in place to incur costs that they would rather not, because they have taken a particular view in relation to it. But the vast majority of claims are resolved, and resolved relatively effectively.
Thank you. And one other quick question. We had somebody tell us, and I guess this is just, again, you may need to draw on anecdotal evidence here, that insurance is being priced for legal exposure, not for risk. Now, if you look at the cases and the world in which you all operate, are you seeing that? like, or how evident is that? I think I know what you're going to say, but like, it was such a, it was quite a big statement to make that, you know, insurance products are priced for legal exposure, not just, you know, versus the risk. Well, you can't have a insurance product without some risk base to it. But are you seeing anything? Are you seeing prices in insurance premiums?
In my experience with insurance premiums generally, the vast majority of it is risk, because what's happening is, for many years, I would say for many years, probably prior to 2000, at least in Australia, that risk wasn't being properly priced. And to give you an example, following the 2011 floods that affected most of Queensland, all of those insurers actually started getting proper flood data. And the only one from memory who had it at the time was probably Suncorp, and they were the only ones who had flood coverage at the time. On that basis. And so what happens for businesses is once that's priced in, it goes up in that space. And similarly, the risk, if you're running a risky activity, recreational activity, that's the cost that's being priced there is, that's a risky activity. It's not the cost that's not being priced is, oh, they might take me to court. That's in a sense the end result or the potential end result of the risk of either the activity being done or where that business is located in terms of a flood, cyclone or bushfire. That's the key driver, not what happens afterwards.
Yeah. Which actually brings me to another one last question, if I may, Chair. We had the recreation industry in here, and they gave evidence, and they were saying that there's for insurance these days, and I'm just again interested in your views. What are you seeing out there? That there's a requirement for 20 million indemnity insurance becoming the default, as opposed to small groups like Scouts or Caravanning Australia or whomever they are, to have slightly lower levels of insurance. Are you seeing that in your world, that there is this move to, like with the clients that you're working with, the groups that you're working with, that there is this default to the 20 million? Public indemnity insurance?
Yeah, I don't know that. Could we take that on notice, Member, for this reason? I'm a plaintiff personal injury practitioner, so I don't have defendant clients, and I don't believe that our Deputy President or Mr Holmes has that information either. I'm not sure that we will necessarily be able to get it. What I can say to you, though, is this. Within the legal profession's own professional indemnity insurance.
Right, yep.
And I'll come back to, and it's a company called Lexon. And all Queensland practitioners, with the exception of some who are in national firms, are obligated to insure with Lexon. It's part and parcel of the renewal of your practicing certificate. Lexon, you have the capacity to, they provide a base cover, and then you have the capacity to take top-up insurance. And what actually dictates the top-up insurance and whether you take it is, in fact, the risk of loss that you as a firm analyse your likely clients to have. And in our own area, if we were to mess up a catastrophic claim by a quadriplegic, for example, it's not out of the question, if their needs were significant enough, that it could well run to 20 million. It's extremely rare, but it's a potential exposure there. So it's an assessment of that nature that must be made. Whether, in fact, it's the default provision to be taken, if you were a leisure activity of skydiving, then I can imagine that would certainly be. It would be a little bit of horses for courses. Can I also just say in relation to Lexon, and Member Moncrieff, you touched on an area before of the ability of insurers to influence claimant conduct, and Lexon, I think, is one of the most successful examples and the greatest examples of insurance influencing and changing member behaviour. So as I mentioned, every member is insured by Lexon. And what they have done over the best part of 2 decades now is they have implemented very strict educational programs where they have toured the state, visited firms sitting there conducting exercises that is supported by hard psychological evidence about changing the mindset of practitioners when they are taking instructions, when they are giving advice. And the premiums that the Queensland practitioners pay are quite extraordinary in the level that they have not increased. And this is in a market where there have been a significant number of professional indemnity insurers that have left. So what Lexon has achieved is a wonderful example of managing a client culture. Now, it's not as easy, and I acknowledge it's not as easy to take that example and apply it to the greater wide world. We're all in one area of practice. But within that insurance product, which is there to ensure that the members of the public do not lose their entitlement, the members are all subsidising the poor performers. The good performers are subsidising the poor performers. So Lexon, for example, have instigated this enhanced management review process, which results in discounts. Yeah. It's initiatives that are available, and Lexon's a wonderful example of it.
Yeah, we're hearing some good examples of things like that, which is good to hear. Now, they're a commercial insurer, right? They're not a self-insurance pool.
No, it's...
Sorry.
No.
Perhaps I can answer that. It's a company that's actually based in Singapore and is subject to the reinsurance pool. So we go to the market. It's a wholly owned subsidiary. So the Queensland Law Society wholly owns the Lexon proprietary PTE, and they ensure that every practitioner in Queensland, as a requirement of your practicing certificate, you must have professional indemnity insurance. Yeah. And effectively, as Mr. Murphy said, what it does is that it collectively means that as a profession we are ensuring that the accidental, perhaps bad apples are getting insurance, whereas without that captive insurance market, it's a circumstance whereby perhaps those persons would not be able to obtain insurance because to the open market, they are perhaps people who have had a claim in the past who might not be able to obtain insurance. So it's a very unique model compared to other professions where that doesn't necessarily exist, but it provides security to the community that if you're engaging with a lawyer who has a practicing certificate, there is insurance if something was to go wrong. And as Mr. Murphy said, there is the ability for top-up insurance, both on the indemnity insurance, but also on additional cyber security policies that they're able to access as well. And it is the responsibility of the firm to decide, do I need, want, or require the additional insurance? Or if it was the case that a claim was over the threshold of my insurance, then they, of course, are responsible for that. But every practitioner has that base level requirement. For some complicated reasons, it's based in Singapore though. And it's been in place, I think, since about 2004, when effectively there was the collapse of the insurance market at that time, which then led to a number of people not being able to be insured, and that led us to Singapore. So it's an interesting model when you're looking at that space of indemnity insurance for a particular profession, for a purpose. It also runs in conjunction with our Fidelity Guarantee Fund, which is effectively a requirement that all of the members, as part of their renewal process, contribute to a fund so that if there is some issue with accessing trust account funds or some issue of that nature, there can be a claim and that money can be reimbursed. So again, the profession as a whole, making sure that the community is protected.
Queensland only, right? I'm just making sure the boundary of what you're talking about is with
Sorry,
Queensland.
Lexon is just Queensland,
Yeah.
but the Fidelity
Fidelity
funds are
Fund.
replicated in other jurisdictions.
And
Okay.
New South Wales, for instance, also has a captive insurance market, but it's run in a different way. It's an onshore captive insurance product that they have, which is very different to ours. We would say that ours performs significantly better than theirs does.
Thank you.
And the contrast I draw there is to the difficulty that, say, businesses in North Queensland who might be involved in strata schemes or businesses in North Queensland generally getting any type of insurance because the market effectively up there has collapsed.
Righto. I am conscious, thank you committee members, I am conscious that we are 5 minutes over our scheduled time and we are to go and have a break and return for our next steadfast. You guys here, ready and waiting. So I've spoken to the committee. I just want to offer you one last. You said, Mr. Murphy, that you had, our job here today is to try and understand why premiums are going up. You said you had an opinion on why you thought, and you spoke about an antidote, but it would take far too long. Can you contract your opinion to 4 minutes?
I will endeavour to.
Okay. Well, if you can do that, hold your thought, get your thoughts together, because I'll put you on the time. But in your opening comments, you mentioned small businesses was hard to obtain. Were there particular jurisdictions or locations where it's harder than others to get insurance?
Far North Queensland is an example.
Yep.
For instance, regional remote communities can be difficult, areas which are exposed to natural disasters in higher rates.
Just
than
wanted
they
you to
have
get that
been.
on the record. Thank you.
And can I add specifically farmers to that?
Farmers?
Farmers
Yes.
to that list.
Yeah, absolutely. Yeah, hail damage?
Hail damage, fence damage, protection against cattle loss.
Yep. Extremely expensive products. Extremely, and that's probably why they're hard to get access to. We took evidence from other parties who spoke about an increase in the courts, about increasing limits of remedy.
Yeah, I can speak to that.
Please, yeah, but just for 1 minute.
So certainly that was, I think, a misstatement in terms of the influence of the increase in courts. The suggestion or the implication was that the increase in court jurisdiction is an example of increasing awards. That's, in fact, absolutely unrelated. What the increase in jurisdictions reflect is the development.
Can you just outline what that was?
Certainly. In Queensland, there is currently a bill before the state government which will increase the district court jurisdiction from $750,000 to $1.5 million.
Okay.
So that's the civil jurisdiction. At the moment...
That's a cap on what a court can...
That's the limit of the award.
Yep.
That's the bottom limit, isn't it?
No, that's the top.
Oh, top 1.5.
Yeah. So the magistrates' court has 150,000.
Currently.
And then the district court is 150,001 to 750,000 currently, and then any civil claim over 750,000 is run in the Supreme Court. What happens with increased wages, increased costs, so on? The awards increase, and similarly in civil litigation, the cost of building, the amount being sued for increases, so that the work levels in the Supreme Court were such that to create greater efficiency in the Supreme Court process, they are increasing the level of the dispute that the district court can consider. It's as simple as that. It does not in any way reflect, or it's in no way a response to insurance costs or award costs or anything like that.
I'm surprised they're not going higher. That'd be my initial reaction in terms of the quality of our district court judges, but anyway.
And the awards have not been changed for well more than a decade. So this is not something that has been changed every couple of years. It is a big jump, but it's in circumstance where it has not been changed for the entirety of my career.
If anything, it's an argument that attempts to reduce costs.
Righto, conscious of time. You've got 5 minutes to explain to me why premiums are going up. There'll be a buzzer go, then we will conclude. The floor is yours, Mr Murphy.
Thank you, Deputy Chair. As I said at the start, there's not one reason and there's no easy answer to it. And one of the things I would be interested in is, if it's at all possible, to get a cost broken down on jurisdiction by jurisdiction for this reason. We have a firm belief, as you would all be aware by now, that the procedural processes that Queensland have in place for the conduct of litigation contribute significantly to keeping costs at a minimum. So to suggest that in Queensland, and that's where we would have to limit the comments to, that it's the cost of litigation or the cost of awards that are driving insurance up is not something that would be supported, in our view, by any hard data. What are relevant, and Mr Holmes and our Deputy President touched on, is the other factors of regional Queensland, the being in the tropical north and the benefits of living there, and the cyclones, the droughts, the floods. And there's all sorts of data around the increasing prevalence of those factors. There, in terms of the recovery of costs, and that being a factor within Queensland, I've referred to the costs thresholds. They have a significant impact on the commercial viability of being able to pursue claims. Claimants resolve claims for less than they are worth to maximise what they receive in the hand themselves. And it's that commercial cost-benefit analysis that's done at an early stage. Does that exist in the other states? Not to my knowledge. So from a Queensland perspective, the other factors that influence the issue or influence the rates of claimants are things like advertising, but you have to balance that with the need to ensure that members of the public are aware of their rights. So there has to be a balance of it. There was, for a significant period of time, there was for some time a presence of claim farming. Now, claim farming in Queensland, and the Law Society was significantly involved in the first response within the motor accident jurisdiction, and then we initiated an extension of that to work cover and the public liability jurisdiction. It's initiatives like that that have lent itself to proper maintenance of and sustainability of the procedures, whilst ensuring that the claimants, and that's what the whole system exists for, the claimants actually can get some compensation which will give them their right to live independently. And there have been references to no-fault schemes, and there's always an ongoing discussion of that since 1972 when it was brought in New Zealand. There are significant administrative costs associated with no-fault schemes. The best analogy for that is NDIS, the cost of litigation in that. And you have people that are representing themselves and appearing in the federal court when the agency have one of Australia's largest commercial law firms instructing silks. And the sheer cost involved in that. Yeah. Now, that is not uncommon when you have no-fault long-tail schemes. Queensland, again, has the benefit. Our work cover scheme is a short-tail scheme. I could go on, but that's the fundamentals, Mr Chair.
You've got 43 seconds left and I'm going to take them off you. Well done. Thank you for your evidence today. Hansard will send you a copy of the transcript, which you're at liberty to peruse and make any changes if you feel necessary. You've been asked to provide some stuff on notice. Yep. you guys?
Sorry, I think Mr Murphy volunteered to take
That's right.
substantial questions on notice in order to
Wednesday the
impose
15th.
additional workload on the staff.
Wednesday the 15th of July. I want it to these guys by, please. Thank you. That concludes this session. I'm going to allow our very dedicated committee members to have a short break. These guys are going to swap out and get ready for our next guys, which is Steadfast, and we will commence at 3:15 sharp. How's that sound?
Well, 3:15 now. So
Oh, well,
3:20.
when I say it's 3:15. We now welcome Steadfast. I understand that information on or pertaining to parliamentary privilege has already been given to you guys. And that allows you as witnesses giving evidence to this committee be background on what your privileges are, and you've received that.
Okay, yes.
For the Hansard record, could you please state your full name and the capacity in which you both appear today?
Okay, Robert Bernard Kelly. I appear on behalf of Steadfast. I'm the founder and managing director and the CEO of that organisation.
Thank you. And you're joined by?
My name is Kasun Jarathne. I'm the General Manager for the Australian Broker Network, and I also look after the broker and insurer services team.
Lovely. One of our committee members hasn't joined us yet, but she will be joining us very soon, so that will not interrupt proceedings. Have you prepared a short statement?
Yes, I have.
And if I could ask you at the conclusion of that, are you right to take questions from
Absolutely.
committee members?
Very happy.
The floor is yours. Thank you, Mr.
I'll
Kelly.
refrain from doing acknowledgement of country because I'm told by the elders that I know very well that when you do that at the beginning of the session of the day, that it's actually impolite for everybody to do it again, and so I won't. I'll respect that from that point of view. Let me tell you about Steadfast. Steadfast is a insurance broker and underwriting agency, or MGA company. We were started 30 years ago. We operate in every state of Australia, New Zealand, Singapore, North America, Greece, London, Paris and Germany. We do 22.5 billion in sales throughout those areas, and in Australia we do 12 billion Australian dollars each year. We have about 1,800 offices in Australia. We also own, and in our complete network we have about 12,500 people who work in our network. We also operate in what's commonly referred to as an underwriting agency, or an MGA. We operate the biggest strata in Australia, which is CHU, and we also have 3 of the major strata brokers in Australia.
CHU. What's that stand for?
Corporate Home Unit Underwriting.
Mm-hmm.
Okay. We have so CHU has 26% of the stratas in Australia insured, and our 3 specialist underwriting brokers do just under 15% of the stratas in Australia. Okay. We are small to medium enterprise people, and we've participated in just about everything. We helped Far North Queensland. We were violated by Four Corners, and it took us a year to be able to correct that through the ACCC, and I must congratulate the chair of the ACCC for actually working with us to set the record straight, so that was very good to do. And we come here with an open heart to tell you and answer any questions you may have. I'd just like to, if I could, before you start the questions, talk about the cost of, and if I could just approach you.
Table this. You stay there. Stay right there.
Have a look at that. Yeah.
So, for the benefit of Hansard, Mr. Kelly is offering a document to be taken, to be tabled.
Yep. So
We'll copy that, and then we'll circulate that amongst the members.
What that document is if you talk about tort reform in Australia, there was a lot of pressure to get tort reform. It came in, and if you look at the start of that particular, did you get it? Right.
Maybe you speak to the document first, and then we'll copy and circulate it.
All right. The document starts in 2005, and you'll see that the amount of class actions in 2005 were 18. So I won't bore you by going through, but in 2020, class actions were 75. Okay, and so when you talk about tort reform, will that help? The reality is it helps in some ways, but eventually the legal fraternity get to understand how it works, okay, and then other things are brought forward. So I don't really think that when people talk about tort reform, I think we've done a pretty good job on it, and I think what we've got's what we've got, and the legal fraternity do a reasonable job. Without patronising the Queenslanders, I've got to only say that what you said about the statutory insurers up here, CTP and workers' comp, is absolutely true. They're outstanding, and if the rest of the country paid cognisance of the way it was done, then we'd be a lot better off. I'm reminded of a document I sent out about 3 months ago that showed that the workers' comp in New South Wales was $2.8 billion in debt. Okay, and then I sent it to a few people who were complaining, and they said, no, we think it's just over $3 billion. I said, you didn't see the date of the document. And it was apart from the AFR, it was May 1974. Now, if you compare that to the way that your pricing's gone on workers' compensation up here, it's outstanding what this system's done. That's the nicest thing I'm going to say about Queensland, because on Wednesday night you're all going to be not very happy, so I'll refrain from going any further. We understand distribution, we understand small to medium enterprise, we understand strata, and we've been doing it for a long time. We started our business 30 years ago. So I'll hand over to you, Chair and members. I'm at your disposal.
Thank you. And I'm going to invite Mr. Jay
Ratner
to now give me, in your words, describe to me what steadfast is, because I still don't understand.
So essentially, and I can give you a very quick history of how we formed. So Mr. Kelly actually had his own small business brokerage back in the 80s or even earlier than that. And I guess in the Australian, broker market, what we have sort of large internationals namely Aon, Marsh, Gallagher, which is the big corporate broking entities, with a lot of smaller suburban regional brokers, and Mr. Kelly at the time actually had one of these brokerages. The challenge is, as a small brokerage, as any small business finds, it's very hard to compete against those internationals because we don't have the same market power, we don't have the influence with the insurers to get the outcomes that we want to get. So Mr. Kelly had the idea in the mid-90s to band together with a bunch of other smaller brokers to create a cluster group called Steadfast, and we operate as one unity or united network rather than act as independent brokers.
So do you have to hold a certain amount of capital to underwrite $22 billion worth of claims?
No, we don't. On our broking side, we don't. We are purely we play an advisor role only, and even on our MGA and agency front, we are only manage the underwriting capacity that is given to us by the insurers, but we don't take any risks ourselves.
Yeah, for instance, we manage $2.6 billion of various insurers' capital, and we put that into the market, and they take the risk. We do the distribution, we do the analytics of it to make sure they make some money out of it.
So you're the brokers?
We're brokers.
Yes.
Yep,
so
perfect.
essentially that cluster group has grown and grown and grown, and now we've got around over 300 individual brokers who act as a network. So and some of them a Steadfast Group has an equity position in, and some of them are non-equity. So they align with our network, but they still run their own businesses. And essentially we provide various services and support to those businesses, and I guess we can in that way we can compete against and I guess get value compared to the internationals.
It's a bit like a franchise.
Sorry?
Is it like a franchise?
No, they're all individual businesses that work in their own environment. They compete against one another, and what we do is we own about 60% of them. Okay, we're a publicly listed company. We're an ASX 100 company. In August 2013, I floated the business into the Australian Stock Exchange, and that allowed us to create capital to allow people in our network to be able to retire. And so we took percentages of their businesses as they wanted to retire, or indeed as they wanted to de-risk themselves and move off from that point of view.
The ultimate motive behind our business is the fact that we think small businesses should be the ones, need to be in the small insurance game, but they need to have the power and the backing of a larger group, and I guess
So you're effectively a cluster of small businesses.
Yep.
which give you an aggregate advantage on buying power when you go to negotiate with an underwriter.
It gives you people, Chair, people will, I don't think I thanked you, Chair, and members for inviting us here too. We got going, so apologies for that. Thank you. It gives small business the ability to do what it does well, which is operate in its local area with its local influence, with the support of somebody big behind them to help them on a whole range of things, from compliance, the training, technology, and indeed to get them up to the front of any underwriting company like QBE or CGU or Suncorp. Okay, they take notice of us. We do. To give you an idea of what sort of power perceived power we have, we do just over $1 billion worth of Suncorp's business throughout Australia. We do about $2 billion worth of QBEs, and we do about $1.6 billion of CGUs. So by bringing all those together, it gives people you get to sit up the front when you discuss with people. You're not hoping to get there, but does it give us purchasing power? It doesn't really. It just gives you the ability to get to talk to people about problems and to get things solved.
Yeah. So today we spoke with a number of insurance businesses, or during the course of this inquiry, and it seems to be the insurance sector is segmented into the mortgage market and then the small business. From what we have learned, the small business sector is mostly dominated by the brokerage firms who, because they need a special skill set and the time and that.
So if you,
it appeared at face value when you spoke to them, they'd always the industry would have cried poor on the margins on the home loan book, but the bigger margins were in the brokerage, in the business sector. What margins do you guys operate on if the majority of your work is?
Well, I think our gross margin is about 20%, okay, on turnover.
Yeah.
Okay.
And but that goes to the broker.
Yeah.
Yeah. That
all goes to the broker.
Yeah.
And their net margin on that is probably about 30% of that. So the cost of running 55% of a broker's operation is wages.
Yes.
Okay. So then it's very hard to control that at the moment.
It's labour intensive.
It's labour intensive, but we built our own technology. We own that technology company, and we're very heavily into technology, so that helps dramatically. We have nearly 8,000 people using our technology in the insurance industry, so that gives you the ability to be able to develop it and to work with it. Yes.
Ms. Jarrett?
Good questions. So I was just trying to understand your model, I guess, in terms of the underwriting piece. So the way you operate is, and I'm probably wrong, but
no.
We have a sector. Let's go with the tattooists.
Yes.
Can't get insurance or find it very difficult to get insurance, etc. Your underwriting comes in and helps those high risk, or what I'll call more difficult sectors, get insurance?
Correct.
That's what
correct.
you do. Okay.
It should be, just to clarify, we call them brokers. The broker will go and talk to a client who could be a tattooist, and the broker would try and procure insurance for that client.
Correct, but there's insurance, and then there's either underwriting, reinsurance that might be needed. Is that where you come in?
You've got to get somebody. You've got to look at the client, look at what they do, get their risk, analyse their risk, and then go out to the market and present it. Now, the overhang that's hanging on tattooists is that was how the outlaw bikie gangs laundered their money.
Yeah.
And so you couldn't insure a tattooist because the competing gangs would burn them up and blow them down. So now if you cross out tattooists, because you should be able to insure tattooists, in fact we've got eight if you look at our web, I think we've got 8 markets that can insure tattooists. So, but if you've got a tobacconist at the moment, then you can't insure them, okay?
Yep.
And if you've got a Now, all of a sudden, this ridiculous thing that's going on in Victoria with the, I had no idea, I mean, I don't drink, but now you've got all this liquor coming in, so now they're blowing up, there's huge criminal activity going on, so most insurers now are going, we don't want to insure anything that sells liquor late at night, okay, and we don't want to insure anything that's got anything to do with tobacco because it's bad. So now if the tobacconist rings up one of our brokers, there's virtually no way you can insure it. A tattooist should be able to get it. If they're legitimate and they're operating correctly and they're licensed, they should be able to get insurance, you know. So I think that it's transcended the fact that it was controlled by bikies. You know, a lot of people, I mean, many people look at tattooists and people that tattooed. I mean, when I was a kid, my mother had 2 rules. You don't go out with any girls that chew chewing gum or have a tattoo. They were the 2. So life has transcended that a little bit. Now tattooist is body art now. So, yeah, there are people that can do it. What you can't insure, I don't know if you follow sailing, but the woman who won the Hobart, which is fantastic, a friend of mine, she has a water ski park on the river, and it just got flooded completely, and she can't get it insured. The reason being, insurance is not about, it's about a possibility, not a probability. So when you do the probability tables on that, you're going to go, well, hang on, it's right on the bend of the river. It's nearly been flooded a few times before, and it's got flooded. So insurers can't rate that. Okay, so that's difficult to do. Now, if I could just have, and generally you hear, and the consumer groups are driving me crazy because they say insurance is going through the roof. Now, all I can give you is to say that we place in Australia $12 billion worth. That's about 30% of the intermediated business in Australia goes through our network. And I've put into Hansard a couple of documents. So the first one shows 2024, and it shows that insurance premiums were going up in January 2024 at 8% across our portfolio. So I won't bore you with but that there's the 8%, and that's January 24. This is May 25, and they rose at 1.7%. So we're not seeing we with 30% of the market are not seeing a gouging position going on, and so the other document I put into Hansard is this one, and what that says is similar graphs, which says, and I'll read from them, the domestic prices in January 24 were going up 12%. The domestic prices in May of 26 were going up 2.3%. Okay, and so if I look at commercial insurance was going up, I'm sorry, 12% was the first one, going down to 2.3%. That's for domestic. The next one is commercial, and it was 8% in January 24, going down to minus 2% in May of 26. And then the bottom one is casualty, which is your liability, a professional indemnity. That was in January 24 plus 4%, and in May 26 it is 0. And 0 to minus. And then specialty, which is that line across the bottom there, you can see the erratic nature of specialty, which would be your tattoo parlours, would be your caravan park. It's like a jigsaw. But the traditional insurance premiums are going that way, and that's factual of our turnover. That's not hypothetical. I put those into Hansard.
Have you got that data going, say, back 10 years?
Yeah.
That you could share with us?
Yeah, we could.
Could we take that on notice?
I can extrapolate that back 10 years for you.
Thank you.
Happy to do that.
So when people are saying insurance costs are going up, and you've just given us data just for the last couple of years that show that it's going down, Are your brokers operating in specific sectors only, in specific industries? Like, I'm starting to question where are these increases?
We're generalists, so we operate from all the way through, okay, every time. Now, we have some brokers who are specialists in cyber. We have one that only do cyber. We've got some brokers that mainly, and that's probably 95%, do strata. But for the rest of them, they're complete generalists. Okay.
The other thing to add is the cost of, I guess, the price of insurance is going up. What these exhibits show is that the rate of increase is reducing.
Yes,
so,
okay.
Thank
you for that.
5 years ago, it was increasing by 8% annually, whereas now it's only increasing by 1%. So it's still going up, but it's just not going as much as what it used to.
That's a fair comment. Thank you.
And that's what I think people. But I mean, we got slammed on the strata industry because we were the largest strata insurer in Australia. We had 30% of the market, and we were dictating the price. We were forcing prices up. I mean, if you can change a market when you've got 30% of it and 70% of it you don't have, then you're a genius. I can't believe it. But take our own situation with CHU. It does $800 million a year in strata insurance all over Australia. We got permission from QBE, which is the capital provider, to put 180 million of that 800 up in Queensland and far north Queensland. And now what happened? We got vilified by saying, it's CHU's dominating the market and putting the prices up. We had to beg to get QBE to give us let us put the capital up there, and we were the only ones writing business up there. So, I mean, there's so many false statements. I mean, the OCN, the Owners Corporation Network, okay, put into Hansard that we controlled 80% of the strata business in Australia and were dominating prices. It was just not true, okay. And luckily, I got to speak in front of the Senate Select Committee, and I got the support of the ACCC to prove. There's so many statements being made like that about small sectors, not major sectors. The biggest problem that insurance has got at the moment is that household insurance was much too low. It was very cheap, okay? And I always remember, don't hold this against me, right, talking to Bob Catter, right, about how we could help far north Queensland.
Chair will have to shut it down.
Yeah, I was going to say, here you go.
Sorry.
Continue, please.
And he said to me, my biggest problem is I know I have people in my electorate that are not insuring their houses, that have got mortgages that say you've got to insure your house. And that's when we started a thing to try and insure parts of Queensland, and it was very, very hard to do because this is what insurers are up against, right? You had Black Friday in 2009, 1.3 billion. You had 2011, the floods, unbelievable. Okay, just under 4 billion came out for that. Then 2018 was free. 2019 you had 2.4 billion in bushfires. Then 2020 you had 2 billion in hail, and then 2022 we had the floods. They're settling out somewhere around 6 billion, and then 2025 we had the cyclone, the storms, the floods, which are again about 5 billion. Now so the insurance premiums were underpriced. They started to put them up to recover what it is, okay, and then they got whacked with a group of other. So many times people think that insurers are making a lot of money. They actually don't make a lot of money for the risk that they take. And I've got no vested interest. I'm a commissioned salesman, so I don't take that risk from that point of view. But
Can I just ask you a question? I know you're talking about not making money. Is there any particular time during that spread of time that insurance companies lost money?
Yes.
In the last few years, they're definitely...
Definitely, yeah. In fact, we can... I'll take it on to give you an extraction of the major insurers' balance sheets, okay, and let you have a look at that, because people don't understand that they actually need to make money to keep capital to keep going.
Mm-hmm.
Yeah.
And I think what's interesting is in the last 5 years, the severity of the...
I just have one question, risk profile, but if you need to keep talking.
In the last 5 years, the severity of the cat events we've seen has probably been unprecedented. And the reality is it's hard for the insurers to quantify this, right? Because the reality is, those 2-3 events we've had in the last 5 years are supposed to be 1 in 100 year events, whereas we've had 3 in the last 5 years. And so that's the challenge, I guess, insurers have, is how do you quantify something that's just doesn't add up to, it doesn't stack up to the models that they have.
If you have a look at the 74 floods in Brisbane, okay, which I was involved in, and you have a look at where the flood levels, some of the places, the Breakfast Feast pub had the flood levels on it. Then you have a look at 2011 where the flood came, and it's gone to there, okay. And then if you have a look at the floods that came the year before last, they went above that. I mean, they built a bund in Lismore, okay, to bund the water so that it went down a river delta and didn't hit the crowd. Okay, they built the bund after the 74 floods, and they took it 3 metres above a 100-year flood limit to take it over. Okay, well, the floods that happened last year went 3 metres above the bund. So that means over the 100-year flood level, they went up 6 metres. So that's the sort of thing that you pay insurance for. But if you try and get a house insured where that runoff went now in Lismore, you'll see the houses. Nobody will insure the houses. And then the insurers get a bad name because they're happy to rebuild the house. But if they rebuild the house, it's where the water is going to come eventually again. So we've been pushing for plot swapping, right? There's lots of land there that's owned by the government. Why don't we just plot swap and put people above the flood zone and then let build the house?
I was just going to, what you're talking about actually goes to the next question, which is about risk profiling and how insurers actually assess risk. Frankly, we've had days of hearings, and to this point, I'm not going to speak for everybody else, but I still don't understand exactly how risks are assessed. But I hear what you're saying in relation to natural disasters. But when it comes to that risk assessment and that risk profiling, over, say, the course of the last 5 years, 10 years, have there been significant changes in how insurance companies are assessing risk, like what goes in behind all of that?
To answer that question, they portfolio manage.
Correct.
Okay? And they look at the locations and they analyse the risk, and it starts at 20, 50 and 100-year flood risk. Okay? And so most of them will not insure now within the 100-year flood risk. Okay? So how do they portfolio manage? They go, okay, what claims did we have going backwards that were affected by flood? And they triangulate those backwards to form a view on what they're going forward at. Then they look at the claims they have now and they go, well, we'd have to insure that place there. I mean, after the 2011 floods, there was a lot of conjecture about everybody should be able to get flood insurance. And a couple of the insurers said, we'll insure anybody for flood. So the people in the Nerang River Delta area there, in cheap housing or cheaper housing, they could get their house insured, not for $650, but for 14 grand. Now, nobody could pay 14 grand. So that the insurers knew where they couldn't insure, and they priced to be able to give that coverage. So our learned friends here were saying, well, the insurers should be able to tell. He said, well, just push the houses up another metre. Do you know what it's like to move a building up? And I mean,
but what about things like cybersecurity? I mean, we hear that that's a huge influence on insurance costs? I mean,
sorry,
you're talking
again?
natural
Cybersecurity.
cybersecurity. Because you're talking natural disasters, but there's so much more that goes into the valuation of an insurance premium.
Yeah.
Correct?
Yeah, but cyber insurance is easy to get and it's cheap to buy, and for an individual, you can insure your house for about $60 against cyber. So that's not hard to do.
Small business?
Small business.
I think there's still a lack of education around.
It's education rather than
the
cost
risk.
of insurance.
Yeah, I think that's the significant issue with cyber insurance. I think yes, the product. If 5 years ago there wasn't enough data around the risks of cyber insurance, so yes, it was quite expensive because I guess the insurers were quite risk averse because they didn't really understand what they were really signing up for. Whereas nowadays there is a lot more data, there's a lot more capacity in cyber insurers in the Australian market, and it is a relatively affordable product, I would say, compared to the risk you're really taking on. However, the problem is around the education. Small businesses don't understand that.
A small business can get full cyber cover for $600, right?
I'm conscious of time, gentlemen.
Probably a
There's
bit more, but yes.
5 minutes left. I might just give the call to Senator Scarr, I think.
Mr. Kelly, you're being taken over.
Yes. The Americans made us it's true. It's true. 2 weeks ago, somebody lobbed a takeover bid for $7 billion on us. Yeah. Well,
Sorry, I won't ask you to comment any further. I just noticed
it's in the market.
No, it's in the market, and I noticed.
I know, and it's in the market. And one thing when you float a company and you get to an ASX 100 company, you think how fantastic you are, and then you think how difficult life is and how hard it is, and then all of a sudden, somebody in Spain does a little chat GPT agentic system that automates something, and it goes out into the market, and the market for us around the world, we had 700 million taken off our market cap overnight. Marsh in New York had $4.5 billion taken off, and it doesn't seem to have re-rated. So then that puts you susceptible to people going, you know what, those businesses are worth a lot more than what they are, and so yes.
Which sort of leads into my question. I've only really got one question, which is to ask for your views with respect to competition in the market in terms of broking services, and also with respect to underwriting services, insurers. So in terms of the market concentration in an Australian context, do you have any views with respect to whether or not we have enough insurers, enough brokers, whether or not there's enough choice in the market?
Look, insurance broking is the most competitive thing that ever exists. There's always somebody out there trying to get your business. So the competition in insurance broking is vast, and particularly when you have models like ours where they all act independently and can compete against one another. In terms of insurers, there's a vast amount of people that will do strata now in Australia. So we've encouraged and supported them to come in because we thought there wasn't a lack of capacity in the Australian market to do strata. There was a lack of people saying we don't want to do it. We're just not going to do it. So I don't think there's lack of insurers, but this is we live in a beautiful country. It's the best country in the world. I've been fortunate for 40 years to travel all around the world. And people always say to me, where would you like to live? I go, Sydney. Right?
Sorry, you said what?
Sydney.
What?
Sydney. Hang on.
Chair.
Hang on. I can speak with authority. I did junior and sub-junior, and I went to St Lawrence's up here.
Oh, good.
Yeah, it took me 20 years to get rid of all that, but I got rid of it. No, there's enough competition. It's whether the competition wants to outlay the capital. I mean, the hardest thing to do is 4 o'clock on Friday afternoon to get a call from somebody who's got a jumping castle, right? And they want to get it insured because they've got a whole lot of little kids who are going to go out and jump on a jumping castle. And there's been some horrific accidents with jumping castles. Now, it's like horse riding. Okay, the hardest thing to do is get horse riding. You know, the pony club things. Ensure because kids get flicked off and people get flicked off them, and there's not enough premium pool that goes into that sector to warrant, as our friend here. Okay, you could get a $20 million claim.
Yes.
You'd have to have $60 million worth of GWP to know to offset that. There isn't the ability to do that. And I mean, I'm faced like Jing Lee that won the Hobart, a friend of mine. She's saying to me, "Come on, Kelly, you must be able to help me, right? Look at how big your business is." I said, "Nobody wants to insure your place right on the water. You're never going to overcome that." In other countries around the world, and we've started with the cyclone pool. For areas like that, they put sovereign capital behind private capital, so they back it up. And we've had a good start with the cyclone pool. It needs to be extended to cover longer periods of time because it covers flood only that occurs in the first 48 hours. Now, as you know, these heads of rivers, they take longer than 48 hours for it to come down. So a vast majority of the floods actually don't occur in the first part of it. It occurs when the headwaters build up and all run down the rivers.
But just for the record, that scheme from your perspective has been successful insofar as it's gone?
Yes, it has been successful, and I take my hat off to the...
should extend the period, right?
Well, its biggest problem is that it ceases at 48 hours. What it needs to do is, if it was reinsured with a reinsurer, they would have 172 hours, so that after the initial rain falls, they will cover any flood damage as a result for 172 hours. In the scheme up there, it's 48 hours.
That's when
Kelly, I'm going to invite you to stick around because the next witness is giving evidence is the Australian Live Music Business Council, and I think there'll be some interesting evidence that may be beneficial to you.
When I was younger, I ran a rock venue in the 70s.
Well, let's get that story.
Hang on.
No, I'm running the show, and I've got to keep it on top. I'm going to get that story, but it might be over a beer after we finish here. So, just to wind you guys up formally, the evidence today from Hansard will be sent to you. You'll give you the opportunity to have a look at and make any changes. Thank you for taking the time to give evidence. I know you've travelled from Sydney, and we do appreciate your contribution. You've been asked to provide anything on notice? Is anyone?
Two things,
Yep, perfect. Well, the most important thing to remember is that these guys want it by the 15th of July.
Sure.
No.
Okay, and you've got their details. But please, take a seat. We're going to just turn Hansard off for 5 minutes while we reset these desks. And I'm going to invite Australian Live Music Business Council to come and get themselves set up. Australian Live Music Business Council. I understand that information on parliamentary privilege and for the protection of witnesses giving evidence to this Senate committee has been provided to each of you. Thank you. And for the Hansard record, would you please state your full name and the capacities in which you appear today?
My name's Andrew Bassingthwaite. I'm a board member of the Australian Live Music Business Council.
Welcome, Mr. Bassingthwaite.
Ant McKenna, I'm the Executive General Manager of the ALMBC.
I now invite you before the committee just to make a short statement, and on conclusion of those remarks, committee members will invite them to take some questions, and we'll start with Mr. Moncrief after your opening statements.
Thank you, Chair, and apologies too from our board member Brian Clardle from Oztix, the Australian ticketing company, who's very unwell and couldn't join us.
What's the name of that company?
Oztix.
Oztix.
Yep, it's one of the biggest independent ticketing companies in Australia.
They've got a have they got a conference down in Adelaide Sunday?
Oztix
Stadiums Australia.
I'm not sure, actually. They may have. I don't know the answer to that.
Sorry.
Oztix do support thousands of events across the country all the time. So, but yes, the ALMBC represents 200 financial members, over 2,000 general members, and approximately 20,000 live music workers across the continent. Venues, festivals, promoters, booking agents, managers, production, publicists, technical crews. Our submission to the inquiry is a joint one, supported really excitingly and very unusually by almost every national music industry association. So everybody in the music industry saying the same thing. We're here because insurance has become one of the biggest single threats to the viability of live music in the country. Since 2019, the average cost of public liability insurance for live music businesses has risen almost to 60%. Many businesses have faced far steeper increases. AMCOS have noted that following COVID, 1,300 music venues had closed by the end of 2023. The closures now have slowed, but the businesses that remain are really among the most fragile in Australia. We call them businesses, but predominantly these are social enterprises. They're not in it to make huge amounts of money. They're here for their cultural benefit to our community. This is largely an Australian problem. Premiums in Europe, the United States and Asia have remained broadly stable, really because of the size of those markets. In New Zealand, they have removed the problem because they have a no-fault accident compensation program. Here, Australian insurers have exited the market, leaving just a handful of offshore underwriters, opaque fees and federal insurance laws that have not been reviewed in 25 years. So we're not asking for any kind of bailout. We've been doing the hard work. We've partnered with the Insurance Council of Australia, tourism bodies across the country. We've built risk assessment tools for venues and festivals. We've found cover for members through trusted brokers and saved venues thousands and tens of thousands of dollars. We've supported the investigation of a mutual insurance model, but industry action alone can't fix this structural market failure. And as I mentioned, it's a joint submission, and we're asking the federal government to play 4 roles. Firstly, to understand that this is a uniquely Australian problem and learn from global best practice, including what's happening in New Zealand. Secondly, to work to increase the number of insurers and underwriters active in the Australian market for live music. Thirdly, and most importantly perhaps, to pursue tort reform, including shorter claim notification periods, caps on legal fees and excesses, and an end to claim farming and no-win, no-fee advertising. Fourthly, to partner, hopefully, with the ALMBC on opportunities such as education, training and risk reduction for live music businesses and patrons. As I mentioned, live music venues really are the incubators of Australian audiences and artists and songwriters and musical storytellers. We want them to survive and thrive. and we're here to answer any questions that you have. Thank you.
Thank you very, very much. Mr Moncrieff.
Thank you, Chair. And thank you for coming in today and for your opening statement. You said that this is a uniquely excuse me, sorry. You said this is a uniquely Australian problem, and you mentioned around increasing competition among underwriters and tort reform. Is that the main driver that are those the main drivers that you see for why this is a uniquely Australian problem?
Yeah, well, I think we have to kind of step back a few steps prior to that. So pre-COVID, the value of insurance, especially public liability, and I'll focus on public liability insurance for venues, was undervalued. COVID hits, we have the double whammy on small venues that one can't have patrons, especially in Victoria. The insurance industry, they're here to make money, and we don't begrudge them for doing that. They've gone and valued and looked at each of the policies and where are they incurring costs on policies, and they've narrowed down to say, well, instead of doing business packs and there's a liability section in a business pack, they've delved in to say, okay, well, we've got an insurance premium that may have been $10,000. We're actually losing money on these insurance packages. Where is it? It's in liability. And where is it in the actual industry sectors? Where are you losing that money? And then they've focused in onto the small to medium-sized venues. And it comes down to a premium pool, and that's where I'm segueing in. That across the industry and overseas, they've got larger populations in a more compact area, larger pools of premium that they can draw on. In Australia, we're very sparse, diverse. We've got a small number of businesses who are offering, especially the small to medium-sized venues. So less premium pool. When you have a claim, it can evaporate that premium pool across an industry sector quite quickly. So the insurance industry here is quite specific. They've said, well, we're losing money where it's small to medium venues, trading after midnight, selling alcohol. Then they've just said, okay, well, we're not insuring them. We saw a huge number of insurers, and the major ones, QBE, Allianz, etc., leaving the marketplace and leaving it for a small number, and that's currently running about 3 overseas and offshore-based underwriters who are willing to write premium.
And are those I mean, obviously we're not the only countries that have small venues that serve alcohol and have live music. What's driving it being a uniquely Australian problem?
Well, it really is about the size of the market. So all across the rest of the world, Europe, Asia, the US, the market is just so much larger, and we see this across all of the data sources about the live music and music industry economy in Australia compared to the rest of the world. It is much smaller, and it's almost of such a small size that these global giants wouldn't even look at it. They just think, why are we even talking about this? Let's pull out of that market. We can't afford any kind of risk. So really uniquely the size compared to New Zealand, which in 1974 did bring in their new process of the automatic compensation claim. And so that is why New Zealand is so different than Australia. So in New Zealand, if you're in any kind of business, whether you're bungee jumping or you're going to see live music, you hurt your finger, there's a certain amount of money that exactly correlates to that. There's no need to have that litigated anywhere in particular to fight for certain amounts. It doesn't matter whether you're a brain surgeon or a tradie. There's very clear outcomes, and it just has it's had a calming effect on the whole market in New Zealand, and that's why New Zealand is obviously different. It does have that very small size of market as well, but the whole market has been really kept calm there because of the 1974 actions of the New Zealand federal government.
You talked as well around in your submission around the mutual insurance model, which you found to be unsustainable. Is that largely for the same reasons as as you've just outlined?
Yeah, it's essentially you're just getting a pool of risks. So you're getting every music venue in Australia to come and join a mutual, and all you're doing is putting in a big pool of risk into one big bucket. So you're not fixing anything. You're concentrating the risk rather than spreading it across a variety of businesses in the Australian market.
I think it was 2022 that we did that investigation before my time and came up with those conclusions. However, there was a group called FEAT, F-E-A-T, that worked with Music Australia to investigate that again more recently. We supported that and got our members involved in that investigation as well, and they realistically came to that same conclusion as well. So it's just the danger of doesn't matter how big the pool is, as soon as you have one or two claims, that just empties the pool out, and then the whole thing is unviable.
Mm. And you've got a self-assessment app, is that right? That's being developed by the ALMBT?
Yes, that's correct. Yeah, we've got a risk survey app. But it's essentially an app that all venues can use, and it kind of guides them through what are the main elements of risks that they need to present to insurers. Mm. So we often find that the small businesses with a small broker don't represent themselves properly to an insurer, and to make them look like they are covering their risk elements correctly. Do they have non-slip stairs? When are they open till? When do they close? Do they have policies and procedures around risk? Mm. So this guides them through that process and generates a concise report for venues and brokers to present to underwriters and insurers.
Where did the idea for that come from?
It came from me a long time ago.
Yeah, excellent. Yes. So it sounds like we're hearing a lot today around risk mitigation being an important part of insurance right across the small business sector, not just music. Is it something that I don't mean? Obviously, it's outside of your scope, but is it something that you've discussed with other related industries around whether they could implement similar things?
Yes, yeah, absolutely. One thing about the actual app, it's very flexible. So we can create modules for caravanning industry, the recreational industry, etc. Restaurants, cafes. It's sort of endless.
Have they been reached out to? Are they using?
Yeah, so we have been speaking with them, but we're concentrating on the live music side first. So once it is launched, then we can talk with the sectors.
So the discussions we've had, for example, with tourism bodies, they've given us examples where advertising campaigns from some of their members have featured people canoeing without life jackets on, and they've had to do the work to encourage their members to, look at how they present themselves. We've done the similar thing with our venues that are our members, trying to get away from using the word nightclub if you're not a nightclub, trying to really represent the exact risk that you have as a venue. Bass was working with the Crowbar here in Fortitude Valley last week, looking at that the Risk Plus app. And we're working with other venues across the country as well. So the kinds of work we do, even a new venue on the Sunshine Coast in Koroiva I've been working with them very recently. They're building an extension and upgrading their liquor licence. So they're going through, they're going through the process of working out the planning tools that they need to, hoops that they need to jump through with local council, for example, whether they should be classified as a theatre or a live music pub. So we work with venues and festivals all across the country on a daily basis and encourage them to understand their risks. To
add to Mr. Moncrief's line of questioning there, what would a typical claim against your industry look like?
It's mostly slip and falls,
yes,
really.
It's slip and falls, assaults. If you say on average, you're probably looking at $100,000 to $150,000. To the extremes where there's been a $6 million claim for a neurosurgeon who's slipped over in a venue.
But realistically, all of our venues, not all of them, but many of them, are in really buildings that were not fit for purpose. They might be in an old warehouse like the Crowbar, or where you have to walk upstairs, or they're in an old pub with slippery stairs. Many of them are in spaces that were never made to be live music venues, and so there is inherent risks in some of those spaces that are almost impossible to mitigate.
So just, can I ask a follow-up question with your indulgence, Chair?
Yeah.
Yeah, you're right for that?
Yeah, sure.
So can I put this to you, Mr McKenna, and we've had other submissions in relation to the no-fault system in New Zealand. So if I put to you, well, I'm the owner of a music venue, I've taken the time to make sure that the venue I've got is fit for purpose. I spend money to make sure that I've got the right type of dance floor, I've got enough staff to clean up smashed glasses or whatever to mitigate against slip and fall. Under a no-fault scheme process, the whole economy is having to subsidise those who aren't doing the right thing, who don't necessarily have the mitigation factors in place to mitigate against the obvious risks, and all you're doing is shifting the cost burden onto everyone, with a number of parties who aren't doing the right thing getting away scot-free. How would you respond to that?
Yeah, I think pretty simply that you would have a membership model that enables you to be part of that process. So if you're a member of the ALNBC, it means that you have to jump through certain hoops and you have to provide some kind of proof of the risk mitigation that you've undertaken, and things like Banshees in Ipswich, the work that they've done with sound mitigation, which costs them a stack of money to do. So there is already well-known processes of individuals becoming part of a member, so RACQ or for examples, and so by being part of that group, you tick the box and say, yes, we are taking responsibility that we have undertaken these risk mitigation processes. If it's then found that you haven't, then there'd be other opportunities for litigation in that opportunity, but we could certainly quite easily undertake those kind of processes and provide that kind of certainty.
Okay, sorry. Thanks.
Thanks, Chair.
We took evidence earlier on in the hearings from, and committee members, please correct me, but I think it was the Songwriters Association, and they were making the claim when they were doing their internal risk assessment on themselves, because they were bundled into the same group as you guys, and they were saying, well, they weren't in licensed premises, there was a much lesser risk, they're not falling over, they're not roadies, falling off the back of a stage at 3 o'clock in the morning after a fifth night on the road, etc., exhausted. And from a risk profile, they were saying, our songwriters sit at home, our sound engineers, work bank hours as such, and had a different risk profile. And I think their intention was to try and remove themselves to get into a different risk class.
Yep.
Are you aware of those comments?
Well, it forms in line with exactly what the work we do across our portfolio of members as well. So if you're a 50 capacity live music venue, you often fall in the same categories as if you're a major 2,500, 3,000 capacity nightclub. So the real issue there is that the major brokers, and correct me if I'm wrong here, Paz, the insurance companies and underwriters don't have any incentive to do the work to actually look at exactly who they are insuring, how do we split them, how do we differentiate between the risk. Because the market is so small, there's really no incentive for those companies to do the work, to look at, okay, what are the different risk categories with these different types of businesses. And so songwriters, producers, recording studios would all fall into that exact same issue.
Yes, that is true in many ways, but there is that final part of actually being able to get insurance. So if you're a venue that trades beyond 12 o'clock and you've got a prior claims history, you won't get cover in Australia. There won't be the underwriter that will back you. And then that's when they're going offshore. So what they call what we call DOFIs, where they're unregulated underwriters based in the Cayman Islands. So they just need their piece of paper for a public liability policy to give to their landlord, then they can keep on trading. But if something happens, someone's hurt, then there's no basis, no substance to that as well.
And we know there's music venues that have exactly that kind of document. It's really worth nothing, and worse than that, it's actually very dangerous, not just for that business, for anyone who hurts themselves in that business as well.
So if the Songwriters Association are sitting outside your tent, to your point earlier on about having as many people in to spread the risk, if they're gone, the risk profile becomes higher. Your premiums then in turn become higher. So you're incentivised to keep those guys in the tent on the principle of spreading the risk.
Well, really, the risk is around alcohol, late nights. That's where
spreading the premium, the premium risk. Yeah,
that's true.
Ms. Jarrett?
Just a quick follow-up from that. So, is the live music sector in the same category as clubs and pubs?
Yes, it is. Yeah.
So pubs.
Yeah, industry.
Even though they won't have live music, pubs are the same.
Yes, yeah. It's essentially the industry classifications are so narrow that you've basically got pubs and clubs in one, and that incorporates all small venues, medium-sized venues as well. So it's great to have that delineation between them.
And if I went back to the New Zealand system that you were proposing, it says that it leaves gaps for non-work-related income loss or other specific illnesses to be filled by private insurers. Do they actually get that insurance? Or is this just the stopgap to really look after care for people who are injured?
Yeah, that's the New Zealand is about injuries, so public liability injuries. So if someone slips in your venue, then it's referred to. It doesn't go to an insurer. It's covered by that.
Yeah, but then who would pick up that income loss? I mean, obviously that's an insurance, a separate insurance product that they would have to purchase. Are you seeing that availability of that sort of insurance in New Zealand? Look, I understand how the system works for those who are injured, but there's all those other pieces.
yeah, that's right. In terms of if the economic loss of a patron who's slipped over and is hurt, that will be covered under the New Zealand scheme. So
under the ACC?
Yeah, under the ACC.
The loss of income?
Yeah, so loss of income. So if you've been injured and you can't work, yes, they're going to cover your loss of income at that time, but also the injury, the cost of hospitals, etc.
Yeah. And does that go beyond live music, pubs and clubs? The ACC, is it across the board?
Across the board.
Yeah.
So they don't have a public liability issue at all in any industry in New Zealand.
I think it came to be in New Zealand because at that time their main kind of international selling point was adventure tourism, bungee jumping, etc. And so that was, of course, a huge issue. But I guess one of our points would be that Australia needs to do that investigation. We need to look at the New Zealand model and say, how does this work? How would this work in Australia? And if if that is an outcome of this committee, we'd be very, very happy about that.
And it could be a two-tiered approach where you're essentially underwriting the insurance industry and caps. So the insurance and premium is based on risk and how much they think an average claim will be. If that could be capped, and then and the government is acting as a reinsurer in the background for anything that goes over a certain amount, that would de-risk the insurers, and they'd have a much bigger appetite to come back into the marketplace and provide cover. But there is a cost associated with that, and how is that funded? I know in New Zealand that everyone still pays a public liability premium across all the businesses, but it's pooled for the scheme. So the same thing would still have to happen, that you'd have an insurer involved, but there would have to be some form of payment that comes from a venue or a tourism industry provider, etc., to support that scheme.
All good?
Good, thank you, Chair.
Senator Scarr.
I'm still, so just in terms of this no-fault scheme, right,
Yep.
in New Zealand, it's got its critics. So the critics say, for example, the tourist operators who took tourists near the volcano that blew up. The critics say that would be less likely to occur if you didn't have a no-fault scheme, because operators would have to be very, very aware in terms of the application of their public liability policies. They'd have to have risk mitigation in place, but under a no-fault scheme, they're relieved of that responsibility, and therefore this is tending over time to make the no-fault scheme unsustainable, and consolidated revenue has to be drawn down to actually prop up the no-fault scheme. How do you respond to that?
Well, I think it would come through accreditation and training. So if a small venue in Australia wanted to participate in a scheme like that, they would have to have the accreditation and training to ensure that they are mitigating their losses and have some controls around that point. But I agree with you. If there are no controls and anyone can do, it becomes like cowboy territory, and that's a problem. I think there has to be a big focus and push on mitigation.
So you only get the benefit of the no-fault scheme if you've ticked all the boxes in terms of minimum standards. Is that correct?
I think that would be our position.
Yeah, that would be our position.
However, we are not experts on the New Zealand scheme.
Yeah.
We would really invite further investigation into that, because it is hard for us to know the ins and outs of how that might work and what people in New Zealand really think of that, apart from our conversations with other music industry people who we work with very closely, who just say to us, insurance is not something we ever talk about, which is very surprising for us, because it's one of the most things that are most talked about by all different players in the music industry.
So one of the points you make in your submission was quite interesting, that you didn't have the industry didn't have these same issues leading up to the COVID pandemic. Insurance was more accessible, but you postulate that perhaps the insurance premiums at that time weren't factoring in all the risk, but it was only with the catalyst of the COVID pandemic, then you shutting down because of restrictions, that the market started to focus on the risks associated with those remaining in the industry. Is that a correct interpretation?
Yeah, that is correct. Yeah, the industry, in terms of investment return for insurance companies, was falling post-COVID. So they were looking internally at their cost base, and that's when they started really dissecting inside industries and found that the premium pools for small, medium-sized venues wasn't high enough to cover the claim costs that were being incurred. So hence, we had some venues that had a tenfold increase in their premiums from $60,000 to $60,000. And with burdens of $100,000 excess thrown on top of that as well.
Which is a huge excess. I mean,
It's
you go to the trouble of getting the insurance, and then you're faced with one example you gave was $100,000 excess.
Yes, that's right.
Which is
it's just not one example. That's not standard, but it's not unusual.
Yeah.
The other point in regards to that is that obviously before COVID, there was just much more competition in the market. There was a larger number of insurers, so it would have been very hard for an insurance company or insurance broker to suddenly raise their premiums dramatically. They would have just been knocked out of the market.
So the other another point you make is you don't think a mutual system would work in the live business environment in Australia. There just isn't enough participants to make it work. Is that correct?
Yeah, that's correct. Not enough participants. And we had the Amusement Association of Australia approached us saying, why don't you join? We're trying to build a discretionary mutual fund.
Yeah.
Why don't you join in with us? But all we could see was just more and more high-risk businesses being chopped into that. And in behind a mutual fund, you have a claims management company. For example, Aon is probably one of the larger players in that claim management process. and they kind of looked at it and said, well, this is unviable, there's just so much risk here. And a discretionary fund there's two parts to it. It's up to the discretion of the fund to pay. So it's not guaranteed like an insurance company. If you have a claim and it's a valid claim, you will get compensated. A discretionary fund can say, no, we're not paying it. It would be highly unusual, but it has happened. And the same thing is that when a fund dries up, the fund puts their hands out to their members again and says, okay, we've got no more money. We need to, everyone has to start chopping up this kitty. So it would only take one or two large claims and it would wipe out a discretionary fund or mutual fund.
So one of the proposals you're putting forward, or it has been considered by another parliamentary committee, is the tax offset. So how would that work? Just walk us through how that would work in practice.
So that's been a lot of work that APRA AMCOS has done over a number of years, and I guess what they're describing is something that's not dissimilar to what happens in the film industry and has worked successfully for a long period of time. So it really just is about taking a certain percentage off the tax. I don't know the full ins and outs, but it's really about
so a combined. So your submission refers to a combined venue offset.
Yes.
Of 5% of expenses for current live music venues.
That's right.
$12,000 in expenses for those not currently hosting, would boost the incomes of musicians and artists by $205 million per year, with an additional 203,200 gigs, end quote.
Yes. So that's about incentivising live music within venues. So I guess it could work a number of ways, but probably would work through quarterly submissions back to a governing body about the number of performances that have been undertaken. It could be an annual model, and I guess APRA AMCOS is the correct agency to lead that process. But we would definitely support them in that as well, particularly linking an increase in live music, and particularly original live music, with reduction in any kinds of fees.
But that doesn't. That's a roundabout way of addressing the issue, isn't it? By providing, sort of giving on the one hand to address this issue in terms of the cost of insurance.
Well, realistically, all of the discussions that we're having with different industry players is around the cost of everything. Insurance sits predominantly at the top of that. However, there are huge amounts of other costs, alcohol tax, all kinds of other costs that all seem to keep going up, and so we're here to talk about insurance, and this is something that most of our members talk about as one of their highest issues, is the cost of their insurance premiums and excesses.
So, and then you have this issue of what are referred to as direct offshore foreign insurers, which are overseas insurance companies selling policies to Australian businesses without being licensed or prudentially regulated by Australia's APRA. So presumably the risk there is someone's just buying this insurance, so potentially they can, for whatever reason, say they've got insurance, but when they claim on the insurance, they find that it's difficult to do so. Is that correct?
Exactly.
Yeah, there won't be any substance to that policy at all. They've basically paid $3,000 or $6,000 for a piece of paper that they can give to their landlord to cover off that element of their lease that they have to have public liability insurance. But when a claim is made, there is no substance. It won't be paid out. It won't be honoured.
So there's no insurance. So the claimant will get a little bit of money from that business. That business would probably go bankrupt and close down, and then everyone loses. The person who's injured gets no long-term support. That business is gone. The venue's likely closed. It's an incredibly precarious situation, and there's quite a few live music venues that we know are exactly in that situation right now.
So some of the recommendations you made, one of them was allow live music venues to include disclaimers for clients and allow some risk reduction for businesses such as venues and festivals where clear warnings are provided and risks are cleared to punters, end quote. Is there anything stopping you now from doing that in terms of, as a condition of entry, someone waives their rights? I mean, I know it's problematic from a legal perspective, at the very least, with respect to people under the age of 18. So children, you just can't do that. But
anyone really, we don't want that.
You don't want to have
punters to be in that situation where they're not protected because someone's written some piece of text on their ticket or whatever. We do want a proactive, co-designed solution to the problem where there is risks that are absolutely clear, and you know, if you're in a live music venue after 12 o'clock midnight, you are taking more of a risk than if you're going into the bowling club at.
Well, there could well be members of this committee in such a venue this evening.
It's about recognising,
speculating,
recognising that those risks exist, and that, you know, we have examples where a punter has walked past a sign that says slippery floor, no entry. They've walked past that sign, slipped over, and the venue has been taken, you know, had to cop out with their insurance. So.
Yeah, there's many examples like that, and this kind of leads into it, like the tort reform and no win, no fee lawyers and that process.
Which and one of the, and just my last answer to the last question, one of the issues with tort reform, and we had the Queensland Law Society here earlier today, is you've got different rules and regulations and different pieces of legislation in each state. Yep. So Queensland has a different system in some respects than, say, New South Wales. So there are various ways in which the Queensland system works which hopefully mitigate against spurious claims going all the way to court and generating huge legal fees and damages payout. Do you recognise that there is differences between different states?
Yeah. So we've worked with the Insurance Council of Australia on that point, but it probably requires a federal framework to say if we are going to do a tort reform, every state and territory has to go through that process. And let's try and get an Australian-based approach to it rather than all the different states doing it all differently. Let's try and make it as homogenous as possible.
We know that's going to be incredibly difficult, but we still want to wave the flag and say it's been 25 years since the last major reform. Let's work together now to make it happen.
So as we're sitting here today, how much is Australia's live music business at risk?
It's hugely at risk. So most of the businesses predominantly are either sole traders or small businesses with, you know, employing themselves or one or two other people. They have hugely narrow overheads and cash flows. They are working predominantly as social enterprises rather than businesses. I don't want to upset the clubs people, but if you want to make money in a venue, you have pokie machines. Yeah. But most live music venues don't do that, and they don't want to do that. They're providing a cultural benefit to our community, and they are providing much of their time as a volunteer to do that. And they love doing that, and they want to do that, and they're not asking for any kind of bailouts to help them do that. But what would be great is if the general community and the government of all levels supports the understanding that live music venues, and particularly live music original venues or grassroots live music venues, are just as important as art galleries, libraries, other cultural institutions that are very well supported and do have very specific frameworks about how they are supported. We don't want government to take over ownership of of grassroots live music venues, but we do want those people and individuals and small businesses that maintain that cultural offering, they do find the support that has been really missing over the last numbers of years.
Okay, thank you.
Just one quick question. We heard this morning that from some of the big insurers, and we've heard this from others, that they like to work with industry sectors and they package up products based off, obviously, the population of that sector, the risk. Is it just, I'm assuming you've worked with the Insurance Council and other groups to come up with some co-designed industry standard insurance for your sector? And it's just not workable in the current framework?
Yes, that's essentially correct. Okay. So in terms of the underwriters that are in Australia, there's 3 underwriters that are actively involved in the small to medium-sized venues. One had several claims last year, and they're close to leaving that market. So we may be down to 2. It's about convincing underwriters, especially if they're generally going to be Lloyd's-based, to bring more, come into Australia, and I suppose it is going to be taking a risk on the industry. So it is about capacity. It is about having more insurers and underwriters into the marketplace, and that becomes then you've got the supply and demand of that. If you've got more there, it's I'm lost for words, but
pretty much the work we have done with the Insurance Council of Australia and various tourism bodies, it's all pointing to the same opportunities. That is to calm the sector by banning no-win, no-fee services, reduce the length of time for notifications of an incident, cap legal fees, publish the claims data because we don't have access to the actual data of claims because it's in confidence. Update the classifications of live music venues and, as you mentioned, the songwriters before, enable more subtlety in the different classifications. Have standards for different kinds of injuries as they do in New Zealand. Cap the excesses so we don't have those $100,000 excesses. And as we mentioned about allowing some kind of disclaiming and then look at other ways of reducing costs as well. So all of those are pretty much across the board that have come through the Insurance Council of Australia's.
Yeah, and that's dealing with the cost side. I think what has been pretty clear to us over the course of this hearing too is the importance of that mitigation. And even when you talked about the ACC program, which you seem to think is a good idea, potentially registration, people meeting certain standards, etc. That to me is a mitigation as well, and that seems to be a bit of a missing piece at the moment in the sector.
I think it's probably across most small to medium-sized business in Australia that's missing. But yes, definitely in the sector that they're worried about costs. If I for example, we were at a venue in Cairns, and we went after the evening, we went out to the back area, and it was dark, and I said, well, here's a risk element that you need to address, because if someone comes out after having 5 drinks, even though they're not intoxicated, it's dark, there's going to be issues. And they say, oh, we've never actually thought about that. So they'll put in a floodlight, an emotion-based floodlight. Yeah. So it is that kind of education piece that needs to occur.
Okay. So we are doing that, but we just do that as part of our kind of process of engaging with members. But if there was some kind of more formulated mitigation type process, we would be very happy to take a leadership role, and there'd be certainly larger members who would help back that financially as well.
Thanks, Chair.
Carreras and friends, Robbie Williams, the Cause, Ronan Keating, a heap of other artists are coming to the Gabba. How do they get insurance?
How do they? Because they're so large, and the fees that they're generating from ticket sales. is astronomical.
Who underwrites that, the concert?
Potentially they'd be the major international companies like Live Nation, TEG, and so they have the buying
Cover the whole
power.
tour.
Yeah, so their whole company. So even some of our members are venue companies that own hundreds of venues, and so they have the buying power to get great insurance premiums and look after all of their individual pubs. However, if you are an individual sole trader running a small business in a, whether it's the Banshees in Ipswich or one of the Crowbar in the Valley or whatever.
I'm writing these down.
Yeah, you should get there. It's great. They don't have the buying power. They don't have that industry power to be able to get a great deal for their members.
We need a site visit, Ivan.
You'll find that the larger venues like the Gabba, the Fortitude Music Hall, they have all the systems in place. They've got the staffing levels to actively monitor and mitigate risk prior to and during an event. So it's a lot more formal process for those larger companies. Small venues just don't have that capacity, and we need to be able to give them that capacity in some form.
Gentlemen, thank you for appearing today before our committee, and that concludes our hearings. I want to thank you for appearing, in particular, you're Queensland-based, aren't you?
Yes.
Yep, so appreciate you travelling across the river. Hansard will send you a copy. You can have a look at that and get it back to them with any changes. I don't think you were asked for anything on notice, were you? There was nothing?
No.
Okay, so there's no need for me to inform you of what that date is. Thank you for your appearance here today. Can I just say that the committee now stands adjourned? And thank you, Hansard.